Tom Mackenzie in London. Here are your top stories. Turning off the taps, the Nord Stream pipeline begins a planned 3-day shutdown while Gazprom halts deliveries to France's Engie. Jobs jolt, US labour data and a key consumer confidence gauge signal stronger demand, paving the way for larger Fed hikes. Plus, back to work. Goldman Sachs and Morgan Stanley call in their employees, dropping COVID rules as Wall Street looks to get back to the office. Let's check in on these futures then. We're weighing up the data, of course, that came through yesterday from the US. Stronger data when it comes to jobs, stronger data in terms of the surveys around consumer sentiment, and then out of China, PMI that weakened for a second straight month, although it came in slightly above the estimates. The futures pointing to gains of 0.6% after the sell-off you saw on Wall Street yesterday at 1-month lows. You're seeing now the FTSE 100 just edging into positive territory. Continue to watch what's happening in the gas space. As we said in the headlines, Nord Stream 1 closing today for 3 days of planned maintenance. The last time, of course, that pipeline closed, it went from 40% output to 20%. We'll see if it comes back with that 20% less or if indeed it remains closed. And that is the concern, of course, amongst EU officials as they work up that plan to adjust the market around gas and electricity. The FTSE 100 currently gaining 0.2%. Over in France, the CAC on up about 15 points. You saw CPI coming in for France, just slightly softer than the estimate. 6.5% was the CPI print. Spanish IBEX currently gaining about 0.1%. Let's move it on, see how things are playing out then in terms of the different assets as we look ahead to the US futures as well. Weighing up additional commentary from Fed officials, just reiterating, along with that data in the survey that got out yesterday, that stronger hikes are possibly likely when it comes to September. That debate continues, 50, 75. Arguably, what we saw from yesterday and the commentary from officials suggests that 75 is still very much in play. Futures stateside looking to gains of around 0.6%. Euro dollar back above that 1 level, but for how long is the question. Not a lot of a movement in the session today. Brent, it is $100 a barrel, and of course we are keeping an eye on what's happening on gas, given that closure of Nord Stream 1, just up 4% on the session today, watching to see, of course, what happens and if that pipeline comes back online. Let's go over to Bloomberg MLive Managing Editor Mark Cudmore, someone, of course, who is very concerned about the implications of gas. But Mark, you are looking at the US housing stock for us today.
Yes, absolutely, Tom. This chart just absolutely caught my eye and kind of really shocked me. It was flagged to me by Brent Donnelly, president at Spectre Markets. He nabbed it off someone off Twitter called Michael Green, but that person on Twitter got it off Bloomberg in the first place. So maybe I should have just been a little bit sharper and better at my job in the first place. This is the supply of US one-family new home sales that haven't yet been started, i.e. it's a plot of land that the builders are trying to sell. It's for sale, but they haven't yet actually started building them. And I'm just trying to show just how dramatic the supply overhang is in the US. This is going back over the last 40 years. You can see the last spike, this is up in 2006, was what precipitated the global financial crisis, the housing kind of crash back then. The spike this time has been even more dramatic. Now, before anyone thinks that I'm trying to say, oh my God, we're going to have a worse housing crash than the GFC and there's going to be bigger implications, I'm not. The demographics are very different. There's a very different backdrop nowadays. I do think the housing market is more vulnerable than people think. I think that there will be a bit of a drawdown. However, it'll not threaten the world's financial system. The problem back here is not just that we had a massive housing bubble, it was that the whole financial ecostructure was massively leveraged to that housing bubble. Nowadays, the financial system is much more robust, banks are more robust, and there are less of that market, those derivatives that are specifically geared to the housing bubble. But don't get it wrong. There is a little bit of housing froth. As rates go higher, that means the housing prices will come down. There will be a small crash in housing prices over the next year or so, and I think this chart just shows how dramatic it is.
Yeah, really, really interesting in terms of the vulnerability of the housing market in the US as we look at the concerns here in the UK as well. Mortgage rates in the US, what, about 5.5% as well to layer on top of that. Thank you, Mark Cudmore, Bloomberg MLive Managing Editor, of course, with a look at the US property market. Joining us now is Virginie Maisonneuve to look at the markets, Global Equity CIO at Allianz Global Investors, but also in the studio, Christine Aquino from our markets team. Christine, we'll start with you on what we're seeing in terms of the market reaction in the last 24 hours. Again, the data that we saw yesterday seeming to firm up the idea that you're going to get a decent size hike, possibly 75 in September, given this consumer has come back and the jobs data, the labour market, still very tight. 11 million jobs, at least 11 million jobs that remain unfulfilled.
Absolutely, Tom. And I think that really just emphasizes the current state that we're in now, which is basically any sort of good news, essentially, for the economy. It's kind of bad news for markets, right? Because that just kind of reinforces the fact that the Federal Reserve and really all these central banks have that room to raise rates that much further. Though, of course, the U.S. is kind of in its own boat here, where there is very much this belief that potentially any recession that would follow the series of tightening could be potentially short and shallow. That's definitely not the case in terms of the narrative that we're seeing definitely out of Europe or the UK.
Virginie, does this data set us up for 75 basis points? Good morning in September from the Fed.
Good morning. Well, to me, you know, it's that theme of the great reversal. And what Powell told us is really he wants to put the genie back in the bottle. And he will not only stop at inflation, but he really wants to anchor the job market and expectations for inflation, which will be the main difference between what we've seen in the 70s and what we're going to see here.
Christine, I want to get your views on what's happening in China as well, because we had the PMI data coming out. It's a little bit better than the estimates, but a second straight month of declines. You layer on top of that all the concerns about the drought and, of course, COVID and what's happening in terms of the pressure on the real estate sector out of China. We know that politically there's the Party Congress now happening around middle of October. How are you thinking about the China effect on the broader global economy and what it means for the linkages between markets?
Well, Tom, we've seen really negative headlines after negative headlines out of China. It seems like all year, really, whether it's lockdowns related to COVID or just that deceleration in economic activity. And, you know, I think it is one of these things that I still think it's kind of an underpriced risk at this point, because this idea of, you know, the world's second largest economy really slowing down to this extent, policymakers are very obviously worried. We're starting to see them really amp up that support for the economy, but also at the same time pushing back against that yuan weakness. And you can really tell that they're trying to kind of really pull in the several levers that they have for managing the economy at the moment. You know, it's still very interesting how that's going to play out for all of these economies around the region that are very much levered to China, and how that bifurcation plays out against the U.S., which again, as we know, is very much in this tightening path, tightness in the labor market, and generally still some pockets of strength as far as the consumer goes. Very interesting contrast here, and it really, I think, will create a bit of a rift between economies levered to the U.S. versus economies levered to China.
Okay, very interesting. I'm going to get more updates from China and the China story in the next few minutes, and certainly, Virginie, we're going to get your thoughts on that later. But for now, when it comes to inflation, China is not struggling with the same kind of inflation dynamics that we're seeing in the US, the UK, or Europe indeed. But you are starting to see, when it comes to the West, signs that maybe inflation is going to start to decelerate at a pretty rapid pace in the next 6 months or so. What underpins that view? That's a bold call.
Yeah, well, I think, you know, clearly the Fed, if you look at the US, the Fed balance sheet explains about 70% of M2 monetary growth expansion. M2 is decelerating currently very, very fast. You had a peak in February last year, and by year end, M2 in the US could be growing at 1.5% year on year versus 5.8% in July, and of course close to 30% in 2020. So what that means is that deceleration, of course, is a lead indicator, not only in terms of growth deceleration, but also inflation deceleration. And I think we'll see a strong, you know, a lower inflation visible in the next 6 months in the US.
Okay, very interesting. Christine, you've been thinking as well about the inflation dynamics here in Europe. We had the print out for France, slightly below the estimate, 6.5%. And then, of course, we have Nord Stream 1 shutting down today, as we said in the headlines. Is this still an underpriced risk? As Mark Cardinal from our MLive team has suggested, the markets are still not waking up to the energy shock crisis.
Yeah, I would agree with that, Tom. And I think you can really see that tussle between the fact that, 75 basis points is now on the table for the ECB as well. So that's going to be interesting to watch. But then on the other side of this is very much a growing energy crisis. And you can understand why the euro then is really just hovering around this parity level, even though that rate story in theory should be supportive for the currency. It really is this energy crisis that's growing and deepening day by day, it seems, that people are really focusing on. And it's really difficult to kind of see a path forward for the euro where it takes on a little bit of strength when you really have this massive negatives catalyst that's hanging over it, particularly as we head into the winter.
Yeah, a number of FX strategists have told us that it's gas rather than rates that is driving the single currency at this point. Christine Aquino, thank you for walking us through some of the key market themes. Virginie Mesner, very pleased to say, is going to stay with us. We'll get more of her thoughts and calls in the next few minutes. Coming up later this hour, we will be talking to the Klarna CEO as the buy now, pay later company reports earnings, and China's factory output contracts for a second month. We touched on this. We're going to discuss the state of Asia's largest economy next. This is Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back to the Open. Happy Wednesday. We are 12 minutes into the European trading day. You're seeing gains, very modest gains of 0.2% across the benchmark here in Europe. Gains in terms of the futures stateside, 0.4% on the S&P E-mini, 0.6 on the Nasdaq futures, euro at 1, and yields lower on bonds, Italian and Greek debt as well. Right, China's factory activity contracted for a second straight month in August. That was as the economy took a hit from power shortages, a continuing property market crisis, and COVID outbreaks. Yes, it is a grim picture for the Chinese economy. We are joined now by Enda Curran, our chief Asia economics correspondent in Hong Kong. Enda, what were the key takeaways for you then from this print? They came in, okay, less bad than the estimates, but a second month of contraction.
Less bad, Tom, but I think enduring weakness is a story for the manufacturing sector. Remember, this had been one of the bright spots of China's recovery, but now we're seeing ongoing weakness in new orders and in output. Like you mentioned, there's no relief coming given what's been happening with the power outages. That's hit logistics very hard. We see that in mobility statistics around trucking, for example, so that's getting hit hard. We know, of course, the real estate slump was also having an impact. And then, by the way, on the non-manufacturing side and services, also slowing down there too. That's reflecting what's happening consumers and tourists due to the ongoing COVID-0 restrictions. Take, for example, the lockdown in Hainan Island. So, you'd have to say, here we are, manufacturing at this time of year was meant to be revving up for the year-end export rush ahead of the holiday season, but it continues to remain in negative territory, and that's clearly demonstrating to you the broader pressure that's on China's economy.
And Enda, meanwhile, we talk about the tightness in the labour market in the US as a challenge for Fed officials. It's a very different picture in China. There is a desperate need for jobs, particularly amongst young workers, and it seems like the crackdown on technology and big names like Alibaba and Tencent has only made that situation more difficult.
It's an acute issue across China, Tom. There's a record number of graduates coming on the market this year, about 11 million of them. Youth unemployment, that 16 to 24-year-old category, is almost 20%. That's a record. Now, the records don't go back that far, but nonetheless, it's not where the authorities would want it. Now, the surveyed jobless rate is falling. That would suggest that the policy is getting some traction, at least in getting some jobs for maybe the older workforce. But you'd have to imagine this is going to be a top priority for the government as we head into the Congress that was announced, the date of which was announced last night. It's coming up on October 16th. This is a level of unemployment that matches some parts of southern Europe. It's a level that will not be tolerated by the Chinese authorities, and one would assume that we will start to see very targeted, specific policy measures aimed at bringing this down over the coming months.
Okay, an acute challenge, another acute challenge for policymakers out of Beijing. Enda Curran, thank you, as always, our chief Asia economics correspondent in Hong Kong. Bringing back now Virginie Mazeneuve, Global Equity CIO at Allianz Global Investors. Virginie, I just want to start this segment then with a question on China and to what extent you're concerned about exposure to that market, whether it is through holdings, for example, of European companies, whether it's luxury or autos or others that have a big footprint in China. Do you start to unwind those positions? How concerned are you about the growth impact?
I really think China is an underpriced risk. And with now the date of the NPC clearly enunciated, policies, of course, the key thing is the COVID policy, but more policy support is going to be implemented. And I think versus expectations, everybody's negative on China. What we're seeing, there was a lot of innovation coming out of China. There was a comment made on unemployment. There's a lot of demand for engineers and for hard tech. As you know, China sort of shifted from soft tech to software or soft tech to hard tech, infrastructure development, green economy, et cetera, et cetera. So I think once we see this reopening at some point, there will be a lot of jobs for those young graduates. Of course, that transition is important, and the NPC priorities are going to be very important.
And we need to see that. That's the key caveat, isn't it? We need to see that reopening. Virginie, you want to stay invested more broadly in these markets. Where is your conviction at this point?
So I think, listen, we had this relief rally. We are now entering a phase where growth is going to slow dramatically. We're in an environment where monetary growth is below GDP growth, for example, or will be at the end of the year in the US. So it's going to be a much tighter game. You need to make sure you've got quality, strong balance sheets, strong leadership teams, but also understand how inflation is going to impact, the lagging impact of inflation through inventories, through demand destruction, how companies are going to be able to balance that. So you want to continue to have a very diversified portfolio with high conviction bets along either your themes, growth and value, and of course, a low vol bedrock if you want to anchor your portfolios. That's still the same strategy, but I believe will be absolutely critical over the next 12 months.
I know this isn't, Virginie, your focus, of course, on equities, but there was a call out this morning or late last night around the risks related to credit and the fact that maybe US credit in particular hasn't tied in, or at least factored in the recessionary risk, the growth impact. Are you concerned about the balance sheets of these corporates, whether in the US or Europe, and the adjustments to a slower growth environment?
Listen, when you have very slowing monetary growth, fiscal tightening, end of QE, business confidence plunging, PMIs coming down, you of course have a risk in this area. The question is how much has been priced in or how much is not priced in. And again, you go back to very careful selection at each corporate level to make sure that you have a strong portfolio. But I do agree that we might have a bit more adjustment in this area to come.
Okay, always smart. Virginie Maisonneuve, thank you. Global Equity CIO at Allianz Global Investors. Okay, let's get the Bloomberg Business Flash now with Alice Atkins. Alice.
Hi, Tom. Snap is said to be planning to lay off around 20% of its 6,500 staff. According to tech website The Verge, the social media company which owns Snapchat is going to start the layoffs today. The report says the team working on minis, small applications made by third parties, will be among the most affected. Bloomberg has learned UK government officials have estimated that gas producers and electricity generators may make excess profits of as much as £170 billion over the next 2 years. The assessment is said to be delivered to the new Prime Minister who takes office next week and is likely to fuel calls to expand the windfall tax on energy companies. Cameron Smith, the second highest ranked player in professional golf, is joining the Saudi-financed LIV League. It comes after weeks of speculation that Smith was defecting from the PGA Tour. The Telegraph reported earlier this month that the deal was worth more than $100 million. In a magazine interview, Smith said money was, quote, definitely a factor in his decision. That's your Bloomberg Business Flash. Tom?
Okay, Alice, thank you. Coming up, returning to Wall Street, two big investment banks removed some of their last remaining COVID-19 protocols, paving the way for a return to the office 5 days a week. More on that next. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our targets.
Spare capacity is becoming scarce. We are running on thin ice.
No one deliberately wants to go into battle, but we sleepwalk into conflict.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrow. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg.
Welcome back to the Open. 23 minutes into the European trading day. You're looking at gains of 0.3% across the benchmark European stocks 600 futures. Nasdaq futures up by 0.6%. Work from home, that big question around the readjustment. Goldman Sachs is lifting some of its final COVID rules, including vaccination requirements. The New York Times says it is seen or has seen a memo ordering staff back to the office 5 days a week. What a shocker. Morgan Stanley is also easing some of its COVID mitigation efforts. For more on this, I'm joined by Bloomberg's Benedict Hummel in Berlin. Benedict, good morning. What are the rules then that Goldman and Morgan Stanley are easing?
So this is principally around the idea of access to the offices. Morgan Stanley has said that testing requirements will no longer be enforced. Goldman Sachs is doing something similar. They're saying that vaccination status is no longer a key necessity, getting access to the office when you're coming into New York from outside. So it basically makes it easier for people to come into the offices. And this is sort of part of the push, particularly by Wall Street, but really the larger economy, the office-based economy, to get people back to the office more than just 1 or 2 days a week or even less. We still have very underpopulated offices, office spaces in places like New York, like the City of London, Frankfurt, Paris. A lot of people over the last 2 years have gotten sort of used to doing at least sort of the bookends of the week, the Mondays and Fridays at home, maybe even more than that. It's almost a generational thing. Younger people have sort of started enjoying the fruits of working from home. And it's the older people, the executives who are saying, really, you should come back to the office more, and this is part of this.
Yeah, that generational divide is going to be a shock to the system for some, isn't it? 5 days a week. Goldman Sachs were kind of really out front on this early on in the pandemic and kind of pushing staff back into the office. Why have banks in particular been so keen to get their staff back in?
They really say it's part of our culture, it's part of our DNA, it's how we do business. You can't really do what we do from home. You can do it for a while if you have to, but once these hurdles are removed, as they now have been, there's really no reason to stay at home. They also say it's a way for younger people starting out in a Wall Street career and a finance career to get ahead, to meet older people, to meet more senior people, to get noticed essentially, and that's, again, the sort of thing you can't do from home. David Solomon, the Goldman CEO, said famously last year that working from home is an aberration. We had the Morgan Stanley CEO bemoaning that people felt fine going to the restaurant but not coming into the office, so he felt there was a bit of a sort of a double standard going on there. But again, younger people have learned to live with working from home at least some part of the week, and turning that back is going to be very difficult.
Yeah, is there a risk on that point then, Benny? Is there a risk in terms of staff retention and attracting talent?
Absolutely. I mean, work from home has become an important metric for a lot of people. They look at what kind of flexibility an employer might offer. And if you're a hard-nosed bank or another institution saying, sorry, guys, you need to come in 5 days a week or you won't come in at all, then some people might look elsewhere and might think about, is this really the kind of life I want to lead? This is 2.5 years. A lot of people have become accustomed to this kind of work from home, work in the office kind of mix. And so younger people in particular, and that's often where the talent war is, they might think, well, this is not really how I'm planning my future. I'd like to go somewhere where I have more flexibility built in. So really, it's a bit of a balancing act for a lot of banks between sort of retaining their DNA, retaining their culture, but also giving people some flexibility.
Benny Hummel in Berlin, shirking the sunshine to be uber productive in our offices. Thank you very much indeed. Coming up, we will be talking to the Klarna CEO as the buy now, pay later company reports earnings. That interview is next. Stay with us. This is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy. I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
Is moving both Citadel and Citadel Securities to Miami. The scoop was broken by Bloomberg's Amanda Gordon.
Welcome back to the Open. We are 30 minutes into your European trading day, and here are your top stories. Turning off the taps, the Nord Stream pipeline begins a planned 3-day shutdown while Gazprom halts deliveries to France's Engie. Jobs jolts, US labour data and a key consumer confidence gauge signal stronger demand, paving the way for larger Fed hikes. Plus, back to work. Goldman Sachs and Morgan Stanley call in their employees, dropping COVID rules as Wall Street looks to get back to the office. Let's check in on these markets then. We talked about that improved survey around consumer sentiment in the US. The jobs market, again, looking very tight. More than 11 million positions unfilled in the US. And that, again, underscoring the view that the Fed is going to have to continue to act aggressively in terms of rate hikes. And certainly officials reiterating that message we got from Jay Powell over in Wyoming on Friday. 2 officials overnight saying that, yes, higher for longer is the trajectory for rates out of the US. The European market's currently just range-bound. After being in slightly more positive territory, you saw gains of around 0.2%. That's come off. So very much uncertain in terms of the direction for these markets this Wednesday here in Europe. The DAX over in Germany down 0.1%. Here in the UK, FTSE 100 down by 0.2 or 11 points. Let's move it on to see how things are playing out across your sectors. Technology was top of the list the last time I looked. It remains there, up 1.7%, despite the likes of HP overnight downgrading its forecasts on softer demand for things like PCs. Autos also doing pretty well this morning, up more than 1%. And some of the safe havens in terms of healthcare utilities leading the losses, down between 0.5 and 0.8%. But there's really a lack of catalyst, a lack of direction for these markets, at least midweek here in Europe. Let's get more in terms of the first word news with Alice Atkins. Alice.
Hi, Tom. The last leader of the Soviet Union, Mikhail Gorbachev, has died at the age of 91. Russian news agency says he passed away in a Moscow hospital after a long illness. Gorbachev pushed for radical change to the Soviet economy after becoming Communist Party leader in 1985. His overhaul unleashed a political avalanche that brought down the Berlin Wall in 1989 and ended Soviet rule 2 years later. Pakistan and the UN have launched an appeal for $160 million in emergency funding after unprecedented floods caused by weeks of monsoon rain. The government says more than 1,000 people have been killed and nearly 500,000 forced into relief camps. Pakistan's foreign minister says shelter, tents and mosquito nets are needed urgently. US life expectancy fell by almost a year in 2021, making the biggest 2-year decline in almost a century as the COVID-19 pandemic ravaged the country. According to provisional government data, life expectancy at birth dropped to 76.1 years, the lowest level since 1996. and two of Wall Street's biggest investment banks are removing some of the final hurdles to fully returning to offices following the pandemic. Goldman will let employees outside New York enter offices regardless of vaccination status with no regular testing requirements. And Morgan Stanley is also easing some of its COVID mitigation efforts. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom?
Alice Atkins here in London, thank you. Okay, Swiss global private markets investment management firm Partners Group has posted a first half profit beat. This despite an expected sharp drop in performance fees. The company says management fee growth has been driven by robust client demand. Joining us now is David Layton, CEO of Partners Group, joining us in the studio. David, thank you very much for coming in. Congratulations on the results. Walking us through what some of the key takeaways were for you, what you're seeing in terms of that client demand in this environment of higher rates, recession fears, of course, and very high inflation.
Yeah, what we're seeing is a sustained interest in private markets is an increasingly important part of client portfolios. We raised about $13.1 billion of new capital in the first half of this year and increased our management fees for managing those assets by about 18%, which I think demonstrates this sustained demand that people have for private markets, even in an environment like this where we see volatility. I think one of the benefits of private markets is that we have a very long-term view on the investments that we make. And I think in this current environment where there's so much short-termism, that appeals to a certain percentage of the clients.
Do you see that kind of fundraising that you had in the first part of this year? Can that be sustained, that level of demand, that level of activity from your clients?
I think it can be. Yeah. In fact, we have reaffirmed our full year guidance for this year of raising between 22 and 26 billion for the full year 22, and that is unchanged despite all of the ups and downs and negative data points that we've had throughout the course of this year.
There of course, has been a significant adjustment in valuations in the public markets. Talk to us about the adjustment in valuations in the private markets and how much further there is to go in that process, if at all.
Yeah, it's a great question. So between 2018 and 2021, the public markets had multiple expansion from about 12 times earnings to about 18 times earnings, and we've seen a correction down to about 13 times. Over that same time period within the private markets, we saw an earnings multiple expansion from about 11 times to about 12 times on average, so dramatically less than what was seen in the public markets. Now, there are certain pockets within private markets, technology investments, for example, where the valuations got very, very frothy, but on the whole, it was much less heated than it was in the public markets. Now, will that correction come down to 10.5 times or 11 times? Yeah, I think it will. And I think buyers and sellers are in the process right now of going back and forth on where they think value should settle.
So what is looking most attractive at this point across the space that you look at, and how are you able to, is it becoming more challenging to generate those returns that your clients expect in this environment?
It is definitely becoming more challenging to generate those returns because for a long time we had cheap financing that could help to facilitate that. And so the private markets industry is becoming much less about buying and selling and leveraging and much more about rolling up our sleeves and fundamentally impacting the businesses that we're investing into. And so we have two strategies to help us to continue to consistently generate those high returns. The first is a thematic approach to investing. And we're finding little pockets of the economy, little subsectors that have some structural tailwinds behind it. And that's where we're dedicating all of our effort. We don't want to serve just anything that just anything the market is serving up at the moment. We want to be very specific, the types of assets that we're going after. And the second is what we call our transformational investing strategies. And so when we take ownership for a company, we are driving strategies that are much more comprehensive than we might have needed to in years past, because you just have to work harder in an environment like this to generate the same types of returns that our clients have become accustomed to.
So you talk about rolling up your sleeves. As you look across the portfolio of companies that you've invested in or that you own outright, how much pressure are those companies, on those companies at the moment as a result of this environment they're in? And are they looking at job cuts, cost cutting? What are you seeing in terms of your portfolio companies, the pressure that they're under?
Yeah, so we have several dozen companies that we have stewardship for. On average, they experience EBITDA growth of about 15% over the last year. And so that's pretty good performance for a portfolio that's having to navigate through all of the challenges that we're seeing. Inflation is certainly a topic. In the first quarter of this year, we had price increases that we were passing through, didn't feel much pushback. In the second quarter, price increases we were pushing back without a lot of pushback. What's interesting is that now as we enter the third quarter, people are really starting to bite back on price increases. And so we're all talking about inflation and what are we seeing? We get pretty good insight.
There's a squeeze on margins then. What's happening?
There's the potential to be squeeze on margins. So we're going back and we're squeezing our suppliers as well. We've actually been able to maintain the exact same margin over this last calendar year, and we reported that to the public yesterday in our results. We had, if you aggregate all of our positions together, about a 20% margin last year, and we had about a 20% margin this year. So we've been able to maintain those EBITDA margins, but it has been a fight.
Do you see that holding up in 2023, that 20% margin?
We do see that holding up, and it's going to be work, and it's going to be a lot of effort, but we do see that holding up.
Just before we let you go, the role of private debt markets in terms of driving activity, public versus private, and that transition. Is this a pivotal moment that we're seeing? What is the longer term trajectory when it comes to these catalysts?
Well, one of the things that we're seeing is that the private equity industry, which has been facilitated by the private debt markets, et cetera, is increasingly becoming a traditional asset class. For a long time, if you were an investor that wanted to get exposure to bedrock companies, you had to go to the public markets. And the private markets was where you went to get exposure to risky venture capital investments and the like. But today, increasingly, investors are turning to the private markets to get exposure to interesting assets that they wouldn't otherwise be able to access in the public markets. And
is that a search for alpha? Is it because the regulatory environment has become more conducive? What is that?
It's a combination of all of those things. You have companies that in a prior decade would absolutely be public companies that are choosing to stay private to avoid the complexity of the regulatory environment. And private markets firms have developed the capital base to be able to support those companies. We today are a $10 trillion industry and have the ability to support companies of a much larger size that, again, in a prior era would have been public companies.
Really fascinating insights into the world of private equity. Thank you very much for coming into the studio, walking through your results as well, and the view that you're going to hold up those margins across the portfolio businesses around 20% in 2023, which would be quite the achievement given the economic conditions that we are facing here. David Layton, CEO of Partners Group. Thank you. Coming up, buy now, pay later pain as Klarna's losses deepen. We will speak to the CEO. That is next. This is Bloomberg.
Now they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
What's happening on Wall Street?
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Welcome back to the Open. We are 43, almost 44 minutes into the European trading day. You're now seeing losses across the benchmark of 0.1%. Futures in the US still holding up, gains of between 0.2 and 0.3 on the NASDAQ futures. Now to a really, really interesting story, one that is consequential across the economy here in Europe, but also the US as well. It has a large footprint. Pay later, buy now, pay later firm Klarna's losses. They're deepening, reporting first half earnings. The fintech company has posted a net loss of 6.2 billion Swedish krona. That compares to a loss of 1.4 billion krona in the same period last year. The company is contending with a worsening global macro environment and increased regulatory scrutiny to protect consumers. Joining us now is Sebastian Siemiatkowski, CEO of Klarna. Sebastian, thank you very much for joining us this morning. What really stood out for you from these results as we look ahead to the quarters ahead in, as we said in the introduction, of course, a challenging environment?
Well, I think that, first and foremost, from our perspective, right? It always gets reported as this increase in losses, and we understand perspective. But actually, the way we look at it internally, which I think is more relevant, is to look at what's the percentage loss as share of GMV, so the total volume that we process. And actually, even today, it's 0.7%, which we are quite proud of in tough times like this. Usually, you see credit card companies at least 30-40% more than that. And I think it really speaks to the quality of our model. Now, in absolute terms, compared to last year, you will see quite significant growth, to your point, right? But that is a combination of our volume still growing at a very high rate. In addition to that, obviously, we also see a mix effect where our US business is becoming much larger compared to our European business, where our losses have been so extremely low over multiple years. So just on a mixed comparison level, the absolute numbers increases quite heavily. But again, we look at it as a in relationship to the total GMV, are quite proud to see the performance of our losses from that perspective.
And Sebastian, I know you've talked about your history of being profitable, and then, of course, you pursued that growth strategy, and part of that was the US element, of course, that growth in the US market. Now you're saying there is a need, and you're hearing this from investors, to go from that growth model to a model where you get back to profitability. What does that transition look like?
Well, I think, that's definitely the case. From my perspective, if we look at the long-term vision of Klarna, which is really to try to disrupt financial industries, and what, in my opinion, has been too high profits at the expense of consumers across the world, and we would really like to change that the retail banking industry from that perspective. That is still as true as it was a few years ago. And what's attractive about it, obviously, is the addressable market here we're talking about is trillions of dollars, and it's a huge industry. So there's tons of potential. Now, what has happened in the investor sentiment is that maybe 6 months ago, people were willing to give us a little bit more credit and expectations that that is going to be happening, and we're willing to pay ahead of that curve. Nowadays, investors are a little bit more but there's some risk associated with those accomplishments, and how fast will it happen, and so forth. So there's obviously a higher level of being careful in assessing fintech in general. But to me, really, I look at the business. We're much bigger and much more successful than we were 6 months ago, and we're improving. So it's a shift in investor sentiment. But the consequence of that, obviously, is that we cannot afford being as forward-leaning. So we have had to reevaluate the size of our investments, and we've also had to reevaluate some of our investment strategies in regards to how many new customers do we bring on board versus how much do we focus on existing revenue per customer and improving the portfolio. So there's definitely a shift there, which unfortunately will not be visible in Q2 here, but will be visible as we start reporting Q3 and Q4 will become more visible as well. There's always obviously a slight delay between the actions you take and the performance.
Okay, well, hopefully we can get you back on Q3, Q4 to talk through those changes as well and what materializes. Sebastian, in terms of buy now, pay later, of course, it's a big part of the business. You're under scrutiny for this part of the business as well. Talk to us about what you're seeing in terms of changing consumer habits. Are you seeing more people using BNPL for everyday items rather than the bigger ticket purchases?
Well, slightly, but again, it's never been a big ticket purchase in our regards. I mean, if you look at our average order value, it's about, $100. If you look at the outstanding balances, we have $70 compared to a credit card of a few $1,000s. So, I mean, in the key aspect here that I think still is very relevant, and this is also something that comes across when we do speak and sit down with regulators and politicians, it's like everything else equal. If 10 years from now, less people have credit cards, more people have debit cards, but then occasionally use services as buy now, pay later to finance selected purchases, that is a better world. It's a better world because people will borrow less. The outstanding balances that our customers see is tremendously lower than the credit card balance. And if you use a credit card, you are borrowing against your groceries and everything you purchase. There's no selection at all, right? And then in addition to that, we don't charge interest, right? While a lot of credit cards in the UK may, for example, charge up to 50% or whatever. So there are a tremendous difference of cost in our products compared to the traditional products in this area.
And I know, of course, you're trying to build out additional services, and you are in the process of doing that beyond buy now, pay later as well. And that's a discussion that we can hopefully have at a future date because we're running short of time. I know you've talked about, and you wrote about this and the distress for you and the other members of the team around cutting staff earlier in the year, around 10%. As you look at the administrative costs across the business, do you expect to have to lay off more people? Are there further strains on headcount that are coming through in the months or quarters ahead for Klarna?
No, because I think what we try to do, because I have the benefit of been doing this for 17 years, so I've seen a couple of financial cycles by now, and to us at least, we felt that we really aspired to make sure that it was a one big effort that we could create certainty for all our employees and create a sense of, and I also think to some degree, I still hear a lot of startups out there, tech companies, that haven't yet come to the decision, haven't yet acted on this, even though there is a clear shift in investor sentiment that all companies in these sectors needs to take into consideration. And so I do think, and also a potentially worsening economy, obviously. So in our world, it was very, very important to rather make, not kind of do it in small portions or whatever, but make the big changes that we needed to do and then kind of move on from there, even as much as it was very tough, obviously, to do them.
Okay, Sebastian, I have 101 additional questions, but we've run out of time, so we really hope to get you on again in the future. Thank you very much for your time. Of course, the CEO there, Sebastian Siemiatkowski of Klarna, one of the biggest fintech companies in Europe. Thank you. Coming up, Europe faces the risk of blackouts, rationing, and a severe recession if Russia further slashes gas deliveries. We discuss the energy crisis next, the next chapter. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Welcome back to the Open. 53 minutes into the European trading day. European stocks now turning lower by 0.2%. Part of that will be linked, no doubt, to what's happening across the energy space. European governments are debating whether to intervene in energy markets and introduce an EU-wide price cap for gas and electricity. Brussels says the European Union's power price setting system is no longer functioning properly and needs reform, but the process of implementation has yet to be agreed.
We have been working on a price cap. You know that this is raising a lot of technical difficulties. So we are not opposed to the idea, but the concrete implementation and technical implementation of that idea seems to be quite difficult.
Okay, the French finance minister speaking there. For more, we are joined by Bloomberg's power and gas team leader, Rachel Morrison. Rachel, what do we know about what is happening in terms of the plans from the EU and, of course, this Nord Stream 1 shutdown?
What we know is that Europe is drawing up plans, a sort of short-term emergency intervention to try to lower power prices, and then also a kind of longer-term reform of power pricing. So the main idea behind that is to try to split electricity from gas costs. So really trying to reduce the influence that the really high gas prices is having beyond just the gas market, so on electricity as well. And as France were mentioning just there, it's difficult because not every country has the same energy mix. They're not going to be impacted in the same way. And the problem with a cap is who pays for the money to cap it. So is it governments? How much would that cost? Where do they get it back from? So that's why also windfall taxes are being discussed at the same time. And these are huge changes that are trying to be hammered out very, very quickly to tackle this crisis as it gets worse. And as you mentioned, we have the flows on the Nord Stream pipeline, which brings Russian gas to Europe. They've halted for 3 days of maintenance. And really, there are huge fears in the market that those flows may not come back at all, or may come back at reduced levels, because they have been operating, that pipeline has been operating for quite a long time now at reduced levels. And we've seen this morning, late last night and into this morning, that Gazprom has cut gas to French utility Engie. So we're really seeing an escalating of what's happening in the gas market and a reduction in flows at quite a crucial moment for Europe.
Just a really great roundup of where we stand. Thank you. Bloomberg's Rachel Morrison, of course, leading our team on the gas question, and we continue to watch what happens there. The pricing now on Dutch gas currently up 10% as we watch what happens with Nord Stream 1. Markets lower by 0.2 here in Europe. Plenty more coming up. Surveillance Early Edition is next. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
The difference between political gossip and policy intelligence. Bloomberg Government provides our clients with expert reporting, analysis, and public affairs tools that give you the edge in reaching policymakers on the Hill. When you're in the business of influence in Washington, information and connections are the currencies on which you rely. For knowledge you can act upon, the difference is Bloomberg Government.
Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrow. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg.
We need to diversify away from Russian fossil fuels to reliable, like-minded sources.
There is a need to, as soon as possible, cut the link between the price of gas and the price of decarbonated energy.
We're committed to getting inflation under control, and there's a path to get there. A recession is obviously a risk.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, in for Francine. Here's what's coming up on today's program. Turning off the taps, the Nord Stream pipeline begins a planned 3-day shutdown as Gazprom halts deliveries to France's Angie. Jobs jolt, U.S. labor data, and a key consumer confidence gauge signal stronger demand, paving the way for larger Fed hikes. Plus, back to work. Goldman Sachs and Morgan Stanley call in their employees dropping COVID rules as Wall Street looks to get back to the office. Well, it's a feeling of deja vu in these markets yet again. Future sessions starting higher, but unable to hold on to those gains as we get later into the trading day. It's been about an hour of cash equity trading. We're down about 1/3 on European stock 600. They've slid for now 4 consecutive gains if these losses hold up. We also had losses in the U.S. session yesterday of more than 1%. Strong JOLTS data, strong job data, and consumer confidence, all of that leading to this picture where the Fed can go at it harder, can possibly do 75 basis points. We are seeing a turnaround on the Wall Street future session up to 0.1%. Euro, that's back up above parity. Some of the gains in the euro have been helped by higher stockpiles of energy. And falling nat gas prices, but that is turning around today. We are moving about 6.3% higher on Dutch front-month futures for gas. Now, looking at the overall picture for European equities, it is mixed, I suppose, if not negative. We are looking at UK stocks. Those are down 0.4%, perhaps leading the picture. Lower DAX equities, German equities, I should say, which were the only region to move higher yesterday, now is falling. So overall, it's just this drifting lower in equities with all of these concerns really gripping Europe and making it difficult to buy. Now, part of that is the 3-day halt of the Nord Stream pipeline. It's a key source of natural gas for Europe, of course, and it started today for maintenance works, that halt. That comes as the region's government scrambled to secure alternative energy supplies and fill storage facilities before winter.
At European level, we have agreed that all member states to do jointly save 15% of energy between August now and March 23. The second pillar is we need to diversify away from Russian fossil fuels to reliable, like-minded sources, mainly also to fill our storages. And here's good news. We have reached now an average in the European Union of storage filling of 80%.
We have been working on a price cap. You know that this is raising a lot of technical difficulties. So we are not opposed to the idea, but the concrete implementation and technical implementation of that idea seems to be quite difficult.
For more, let's get to Bloomberg's Berlin bureau chief, Birgit Jennen. So, Birgit, you know, we have Europe discussing a lot of different models here to try to keep those energy prices under control. What is the position that Germany finds itself in this debate?
Yes, I mean, the German government, I mean, Habeck, who is basically looking at a mechanism which could work, echoed exactly what Le Maire just said, that really a price cap is extremely difficult to implement. It's not only costly, but it's really a massive market intervention, which at least the German government would like to avoid. They do want to limit the market effect. But obviously they are aware of the price fluctuations, which they would like to get under control. And therefore they're looking at a mechanism which allows to tap the profits. How it is going to work has still probably to be looked at, and they will discuss this at the next Energy Council meeting. But they are looking at a kind of state power in order to a buying system, in order to basically take away profits and actually then pass it on to later on to the renewables.
We also have Nord Stream pausing, of course, for maintenance that was already planned. But the fear that arises from this, as it has in the past, that flows from Russia will stop through the rest of Europe. Do we have any more insight? Does Germany have any more insight into this maintenance work and whether it will result in reduced flows?
Well, this is exactly the problem that Germany has at the moment, not an open channel to Russia and even also to Gazprom. The talks are just seemingly non-existent, what we hear. So therefore, the German government is really at odds. What is going to happen? And that has been for a while now, and that is exactly creating the uncertainty Germany is under. It's even if Russia is going back afterwards, they do know to the 20% they have been delivering before the maintenance work. But the government knows that this uncertainty will prevail, and therefore they are looking for a solution to make the market more stable.
All right, Birgit, thank you very much for the update. Bloomberg's Birgit Jennen there. We're now joined by Klaus Bader, Global Chief Economist at Societe Generale. So, Klaus, I mean, look, a lot of uncertainty when it comes to the European energy story, especially when it comes to what sort of fiscal support we might get. Is there a scenario where fiscal support is enough to stave off the worst of the energy crisis, which we're expecting Europe to face?
I don't really think so. What I think is possible is to, find mechanisms in which to support those that are really hurt most. I would argue that middle and upper middle income households, upper income households, of course, don't really need necessarily the support here. I favor actually transfers to households. I think they're less complicated. That really need it. It'll be difficult in the short term to really avoid something of a power crisis in Europe and in Germany in particular. In the short term, in the medium term, of course, Germany is building new facilities to import LNG. But in the near term, it's not easy. But there are a number of things that can be done. Germany is discussing keeping running its nuclear power plants a little bit longer than expected. Unfortunately, one of the consequences too that we're using a lot more coal and coal-powered energy, which of course is absolutely horrendous from a climate perspective.
I mean, I gotta wonder if there should be a discussion in terms of trying to curb households' usage of energy, whether that should be more prevalent, because, Klaus, I've heard people come on this program and say essentially that talking about price caps has this perverse effect of increasing demand for energy among households, which, of course, is not exactly what you want in this current environment.
Exactly, and that's my thinking when I'm saying I think it would be much better to just let the price set itself and support those with direct transfer payments who really need support rather than reducing the price. Because if you don't reduce the price, people are not going to save energy. But I think the story, I actually look at it with a certain amount of optimism, because the fact that Germany is as far advanced in the building of its reserves, building up, filling up its reserve capacity, I think shows clearly, despite the fact that the Nord Stream 1 has only been delivering gas at a rate of about 20% of what it did previously, clearly shows that consumer have reacted. And I think, there's lots of low-hanging fruits. We can turn off the streetlights after a certain hour, or maybe turn off only every other streetlight. In public sector, just a silly little story recently, I went to the office relatively late at 11 o'clock here at Canary Wharf in London, and there were 5 escalators running. At that time, 2 escalators would do it perfectly. And so I think that there's lots of low-hanging fruit. I've seen it, in Asia and Japan and Korea, where there really are concerted efforts to reduce energy consumption. It is definitely possible without people freezing to death.
Yeah. I'll do you one better. Bloomberg in London. I don't even think we have any escalators here. But Klaus, okay, look. So at the time we're talking about an energy crisis in Europe and what can be done, over at the ECB, debates are unfolding about whether it's 50 or 75 basis points. I mean, does this conversation make sense? Does it make sense for the ECB to start moving into restrictive territory where at the same time we're talking about the possibility for blackouts in Europe?
Well, I think when you say blackouts, I think you're slightly jumping the gun on that. But yes, I think it absolutely does make sense to raise interest rates, because in the long term, you know very well which are the income groups that get hurt most by high inflation. It's the lowest income groups. And stabilizing inflation expectations, I think, is absolutely key, not just in the euro area, but in many other economies as well. Because what we are seeing is really, in Europe, it took a bit longer. In the US, we're well ahead. And in the UK also, you're seeing a very significant acceleration in wage pressures. That is going to increase cost pressures on company, and it's going to mean further price increases. So, I think to me, it's very clear, and I've been arguing this for a long time, that monetary policy was just completely out of whack with the economic reality. And central banks have held on to this narrative of temporary inflation for way too long. They're behind the curve. And I think we need to get away from these levels of interest rates. But, don't forget, in real terms, interest rates are just dramatically negative. And I was just looking yesterday. I was looking yesterday at a couple of indicators of financial conditions from the Federal Reserve System member banks. And in the US, financial conditions are not tight. And I would argue that in Europe, financial conditions are also not particularly tight. The difficulty the ECB, of course, has is what is going to happen to peripheral spreads. And that's the big concern for them.
All right, Klaus, hold that thought. We're going to continue the conversation, especially when it comes to the Fed as well. I want to get more of your thoughts on that. Klaus Botter, Global Chief Economist at SocGen, is going to stick around with us. Now, coming up, U.S. labor data and a key consumer confidence gauge indicate stronger demand, paving the way for potentially bigger Fed hikes. At least that's what the market has started to price in. We'll discuss that next. This is Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China. But African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window. They have thorns on them.
Top names at the Fed are on Bloomberg.
I have a baseline case going into September that is 50 basis points. That's where I've been since the last meeting. But I have an open mind about whether 75 is going to be necessary. 50, 75 doesn't just depend on a data point, even an important one like the CPI. I like to say that we're data dependent, we're not data point dependent.
Nobody covers the Fed like Bloomberg, your global business authority.
You've likely seen that over the last 4 meetings, we've raised rates 225 basis points. We've started shrinking our balance sheet, and we've signaled there are more rate increases to come. We're committed to returning inflation to our 2% target, and we'll do what it takes to get there. The pace of when we get back to our target, which is 2%, is uncertain. But as a result, our commitment to bring inflation down, which hopefully you welcome, leads to worries about a recession. And I understand why.
Richmond Fed President Thomas Barkin there speaking in West Virginia. Some lines crossing. Italy's preliminary August CPI rising more than expected, coming in at 9% year over year. The estimate had been 8.2. Of course, CPI numbers coming in fast and thick this week. We had Germany yesterday about 8.8%. Well, let's get back to the U.S. story. Still with us is Klaus Bader, global chief economist at Societe Generale. So, Klaus, I look at some of the U.S. data yesterday. You had JOLTS numbers, those indicating yet again a very tight labor market. Consumer confidence also surprising to the upside. How are you interpreting this incoming data at a time where it feels like it's just a world bracing for an impending recession?
Well, I think that, first of all, it suggests that there isn't an impending recession, maybe in a couple of countries. In the UK, I think probably recession has already started. And in Germany, it's pretty likely that we're going to get a shallow recession. But in the euro area, actually, we don't expect a recession. As far as the US is concerned, we don't expect recession to materialize before, maybe early 2024, but it's not imminent. Now, I thought that the data yesterday was very interesting. I don't care much for consumer confidence, and I think consumer confidence usually gives a terrible guide to consumer expenditure. In fact, at the current junction, it seems to me that all those recessions, that people are so worried about a recession that they're resorting to retail therapy. The U.S. consumer spending has continued to be very strong. But yes, I found the numbers yesterday, the JOLTS numbers, very interesting. They first of all revised up the previous month, then it showed a gain in open positions. And one of the metrics that I like to look at is what they call in Japan the job to applicant ratio. And in the US, that had peaked at 1.99, it slipped to like 1.88. And yesterday's numbers, courtesy of that increase in job vacancies, and of course a very significant reduction in the number of unemployed in the last monthly report, this ratio has once again increased to basically match its peak. And the other thing that I saw, the labor market is still incredibly strong. And secondly, what I found really interesting is that in the latest national accounts data, the U.S. corporate profit margin, that's on a so-called NEPA national accounts basis, actually increased. And when you look at the price pressures on companies, both from upstream price pressures as well as from labor costs, that's really not what you'd expect. We think that the corporate profit margin is a really important driver of recessions. And that increase in that profit margin has, in our view, moved out the recession even further into the future.
Let me play devil's advocate, though, because Mike Wilson over at Morgan Stanley has pointed to the fact that he thinks that corporate margins are going to start to come under pressure given inflation, given continued supply chain weakness, and at the last earnings season we got, it basically was just pushing out the pain. So are you essentially saying that you don't see that deterioration in corporate margins?
I do see that deterioration. Absolutely, I see that deterioration. That's what I'm saying. We could be there in 2024, but what I'm saying is that this, and you have to differentiate between companies' profit reports and the corporate profit margin in the national accounts. They're slightly different beasts. But what this surprise increase suggested to me that actually the recession is further out into the future than I've thought previously.
Interesting. I mean, what does that mean?
Profit margins are going to come under pressure. I think that's inevitable. But profit margins are at a very, very high level. They're way above the long-run average.
So, Klaus, we get a recession further out. This is fascinating because we currently have a market right now that's pricing in Fed cuts September 2023. That's been pushed out, of course. But are you saying that the market also needs to readjust its pricing as well, that perhaps any potential Fed slowdown won't occur till the time you're talking about, when we perhaps get a recession further down the line?
Yeah, absolutely. Markets have been incredibly aggressive about pricing in Fed cuts. I think that's very premature. I think it's going to take significantly longer. We're seeing that the Fed has to work hard to slow down the labor market. And, there's one thing too that I've been, that wave, I've been riding that now for quite a while. For me, they're what I call excess savings. Now, I want to say that what I mean with excess is over the pre-existing trend. And actually, in most economies, most advanced economies, that building up of excess household savings has continued. The U.S. consumers have been the only ones who've kind of dipped into this, meaning that the household savings rate has dropped below the pre-crisis level. They're not actually dis-saving, but they're saving less than before the crisis. But and they're supporting consumption, but the degree to which they are dipping into those savings is very, very small and very stable, interestingly. In fact, in 7 months of this saving, U.S. households have used up, according to my calculations, about 6% of the 2.56 trillion that they had at the beginning. And that number, by the way, is
so definitely not. So definitely not through the savings. Klaus, I'm sorry, I'm afraid we're going to have to end things there, just up out of time. Thanks so much for joining us, though. Klaus Baader, Global Chief Economist at SocGen. Now, coming up, China's factory output contracts for a second month. We'll discuss the state of Asia's largest economy next. This is Bloomberg.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. China's factory activity contracted for a second straight month in August. That was as the economy took a hit from power shortages, a continuing property crisis, and COVID outbreaks. We're joined now by Enda Kern, our chief Asia economics correspondent in Hong Kong. So Enda, digging through the data here, what are some of the main takeaways?
I think output and new orders, I should say, were definitely among the weak sides of this, Danny. The manufacturing side, it actually nudged up a little bit, but remains well into contractionary territory. That's because of the pressure on the industrial side of things from those power outages, of course, and from slowing global demand for goods out of China. So the manufacturing story is definitely still in something of a rut. But on the services side, we saw slowing growth on the services side too, and that's mostly down to tourism and consumers not spending as much. You have to look at Hainan, for example, the holiday resort island that came under lockdown, to explain what's going on there. So you take it all together, it all speaks to a lot more pressure on China's economy.
And how does this end? Does it end with government support? Does it end with, weather, droughts, all of that getting better? I mean, how far are we from a turning point?
Well, something has to pivot, Danny, no doubt about it. The feeling so far is the policy support going to the economy, about 1 trillion yuan worth in total, is not enough, or at least is not having traction. So there's going to need to be a pivot somewhere. Will it be the zero COVID? Will it be on the real estate sector or something else? We don't know yet, but we do have a date for the all-important Party Congress coming up now, starting October 16th. That won't lay out definitive plans for the economy, but it could certainly give a signal if there is going to be policy shift around them.
All right, Enda, thank you very much. Enda Kern, they're our chief Asia economics correspondent in Hong Kong. And yeah, Asia market's not too upset, it would seem, by some of these numbers. We did see gains are basically flat in Chinese equities, and the renminbi gaining slightly against the dollar. All right, coming up, we're going to turn to the UK with Treasury estimates showing energy firms are set for billions of pounds in excess profits in the coming years. Could the windfall tax on power producers be extended as we look at price caps set to raise by 80% from October, with the squeeze on energy bills and consumers possibly paying triple for energy this winter? More on that next. This is Bloomberg.
Now they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Turning off the taps, the Nord Stream pipeline begins a planned 3-day shutdown as Gazprom halts delivery to France's Engie. Jobs jolt, U.S. labor data, and a key consumer confidence gauge signal stronger demand, paving the way for larger Fed hikes. Plus, back to work. Goldman Sachs and Morgan Stanley call in their employees dropping COVID rules as Wall Street looks to get back to the office. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now let's get to a Bloomberg exclusive. UK gas and electricity producers could be in line for £170 billion in excess profits over the next 2 years. Now that's according to the Treasury sum. It's something officials will be presenting to the incoming Prime Minister and shows the potential of expanding the windfall tax. Joining us now on this is Bloomberg's Lizzie Burden. So Lizzie, if anything, this Bloomberg scoop, it highlights some of the internal wrangling within the government. What do we make of it?
It's a big scoop from Alex Wickham and Todd Gillespie here at Bloomberg. It heaps pressure on whoever's the next Prime Minister, thought to be Liz Truss, to continue the windfall tax. And of course, Truss has said that she's opposed to a windfall tax because she says that it puts off investors. And Kwasi Kwarteng, the man who's tipped to be her Chancellor, has also said that he's opposed to it on principle. But of course, both Truss and Rishi Sunak, her leadership rival, have said that they would give more support for households through the cost of living crisis. It's not exactly clear how much. These estimates show that if the windfall tax were continued at 25%, it would generate tens of billions of pounds in revenue for the Treasury, which could be used to help people with their energy bills this winter, which of course we know are set to triple from the levels last year.
And with those raising energy bills, I was looking at a Goldman report essentially saying that if we see another hike of 80% in the cap come January, inflation in the UK could hit 22%. I know there was that Citi report from a while back, what was it, last week, the week before, saying potentially 18%. Where do we stand when it comes to inflation in the UK?
Well, to just put a bit of history into it, RPI was at, I think it was 26% in 1975 because of the oil shock. So it's reaching that level as if this Goldman forecasts anything to go by. It's based on energy bills rising to £3,500 in October. And then, of course, forecasters saying that they could go above £6,000 next year. But even if 22% is an aggressive figure, what it really shows is that the hopes of inflation peaking in October are starting to fade. Goldman has said that it would trigger a 3.4% drop in GDP. It says even if energy costs do moderate, it would still be a peak of 14%. So it really underscores the scale of the crisis that awaits the next Prime Minister and the pain the Bank of England's going to have to inflict to bring it under control.
Lizzie, thank you so much. That's Bloomberg's Lizzie Burden, which sets up our next guest perfectly. Joining us now is Charlie Bean, former Deputy Governor for Monetary Policy at the Bank of England and now professor at the London School of Economics. Charlie, I got to say, it's hard not to listen to Lizzie, the concern about inflation, energy bills tripling, and not get this pessimistic view of where we're heading when it comes to the UK economy. Are you pessimistic? What's your base case for where the country's economy goes from here on out?
Well, the country is certainly facing a pretty challenging set of circumstances. Lizzie was mentioning back in the 70s. Now, I'm old enough to have started my professional career back in the 70s in the Treasury. And that was a pretty challenging time. And it wasn't just a single spike in inflation. It was persistently high inflation. While the immediate prospects for inflation obviously depend heavily on what happens in the Ukraine and the gas prices and so forth, which I think are essentially unpredictable. So when people are saying, is inflation going to go to 22 or 18? We don't know, and nobody should claim they know it's going to know. They know, but it is likely to stay pretty high. What worries me, and I think will be worrying the bank and the Monetary Policy Committee, is the extent to which that inflation then gets ingrained into the system with people asking for higher wages to compensate, which we're seeing now, you know, all the industrial unrest.
Is it not basically ingrained at this point if we are seeing just wages surprise the upside every single time we get the data?
I think to some extent the answer is yes. People have focused on inflation expectations, but they have tended to forget this, what used to be called real wage resistance, people trying to preserve the purchasing power of their pay, and equally businesses pushing through the cost increases into their final prices. For that reason, and given that the labour market is still pretty tight, I think we will see more persistent inflation than perhaps people have factored in. And the consequence of that will be that monetary policy has to remain tighter for longer than one might hope. Now, I may be wrong in this. This is one of these areas where we don't know, but that is my fear.
Well, it does feel like one of the things that we're grappling with in this country right now is the idea of flying blind, especially as we're looking at an incoming prime minister, different proposals there. You have Liz Truss talking about tax cuts. You have everyone talking about immediate relief when it comes to the energy bill. Are we flying blind in terms of what the impact to those types of things will be on inflation, on the economy, and everyday consumers?
Well, I mean, some of the policies that people have talked about, we know what their impact is likely to be. Maybe not perfectly. If you support households' incomes, you maybe don't know how much of it will be spent and how much saved and so forth. But we've got a rough idea how people will respond. The problem with the uncertainty at the moment is that we don't know what the policies are going to be, and won't until the conclusion of the leadership election. Now, I mean, all the polling seems to suggest that it's likely to be Liz Truss. What worries me about what she's proposed so far, which of course may be very different from what is implemented, is that the tax cuts that are a centerpiece of what she's offering aren't really targeted at the households that are suffering most, does relatively little for small businesses as well, and more particularly, they're intended to be permanent.
And if I can jump in here, Charlie, I mean, this is coming at a time where we're getting rates that are moving higher. Can public finances handle higher rates and an increasing public debt burden if we are to see tax cuts?
I think just as in the pandemic, the government could finance a large, short-lived deficit. If people can see you're borrowing for an emergency, then I don't think there is likely to be particular difficulties in financing that by borrowing. What will be far more problematic is if you're running an ongoing deficit. And I think the tax reductions relative to what are presently programmed in run that risk. And certainly the 30 billion headroom that was in the last OBR forecast, which Liz Truss had argued should use to finance getting rid of the national insurance increase and not going ahead with Rishi Sunak's planned increase in corporate taxes. That 30 billion won't be there now. We've higher debt interest, there'll be higher welfare payments because of the higher inflation. Lower growth is also going to damage tax revenues.
What sort of
higher energy prices are going to damage the supply side. So I actually think the medium-term fiscal position will be even more challenging than it was back at the beginning of the year.
And you've been in the room where discussions of these have happened, not just for the OBR, but for the BOE as well. What sort of bind does this put Andrew Bailey and his colleagues in?
Well, the immediate difficulty facing the bank is their next decision will be taken without knowing probably what the government's fiscal actions are going to be. But the rhetoric, certainly at Jackson Hole last week, was much more hawkish from both Jay Powell and the ECB, and also from Andrew himself. So I think they will be torn in that they want to keep on sending the message they are going to make sure inflation is brought back to target, but also wanting to wait to see what the fiscal actions are. Looking beyond that, the thing that may be difficult is if the government does go ahead with fiscal actions which potentially open up a large sustained deficit in the medium term, so it's not a short-term action, but raises questions about the sustainability of the public finances, coupled with the suggestion that they may rewrite the mandate of the bank and so forth. I could see investors starting to think the UK doesn't look such a good place to invest. You'll see a risk premium re-emerging on gilts, which is already starting to happen.
Front end of the curve up at 2008 levels.
But in the worst case scenario, you could see a very difficult situation evolving for the government in the autumn or early next year, when it finds it much more expensive to finance its borrowing. And sterling is coming under pressure, which forces the bank to run a tighter monetary policy.
Yeah, I had a guest on the other day who was talking about parity or worse for sterling versus the dollar. So certainly a conversation being had now. Charlie, afraid we're out of time. Thank you so much for joining. It's been great to have you on. Charlie Bean there, former Deputy Governor for Monetary Policy at the Bank of England and professor at the London School of Economics. Coming up, we're going to talk private equity with Simona Malleri, co-head of the Alternative Capital Group at UBS. Don't miss that next. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our targets.
Spare capacity is becoming scarce. We are running on thin ice.
No one deliberately wants to go into battle, but we sleepwalk into conflict.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London. With volatility and crises plaguing many financial markets, companies and investors are increasingly looking to alternative investments. Now, after a record in 2021, private equity interactions have declined about 30% this year, but they're at over $970 billion. And that volume, well, it's still high compared to historical averages. We're joined now by Simona Malleri, co-head of Alternative Capital Group at UBS. Simona, thanks so much for joining us. I mean, look, 2021, it was kind of a weird year, and just, you know, private equity had so much making up to do for the pandemic. When we look at the slowing volume this year, to what degree does it slow to what looks like crisis levels, or do you expect it to be maintained despite everything that's unfolding in Europe?
We have seen actually an extraordinary resilience in the first part of the year, which has been somewhat counterintuitive given the geopolitical and the macroeconomic backdrop. So as you just said, the volume of deals went up compared to last year still. And the reason is because there is still a lot of money to be spent. There is $1 trillion of dry powder that needs to find an avenue to be spent. And also a lot of the deals that happened were deals that were cooked in 2021. And then we saw syndicated loan markets, we saw the high yield market in distress, but private credit came to the rescue and provided fuel for a lot of deals.
Yeah, and of course what we see when there's not a lot of deals available, there's a lot of dry powder. Firms end up paying up more because they need to get the deals. Supply is just low. But as we look at valuations crack in public markets, do you expect that same cracking, or have we seen it in the private arena?
We will see it. I think valuations are already going down. When you look at the deals in Europe that have been done in the first 6 months of the year, the medium valuation has been around 11.5 versus the 14 times we've seen last year. So these are levels from 2016. Now, it's normal that valuations are going down. There is a mathematical effect of interest rate going up, discount rate going up, valuation going down, but it's also portfolio companies are suffering. They're suffering because of margin pressure, supply chain disruption, labor cost, and you name all the issues I'm sure you've been discussing. So I expect valuation to go down. We're not there yet, meaning we need to find a new equilibrium. It's a bit like, I always say, like the real estate price in London. They never really go down, but there is a time where still seller have high expectation and buyer wants to buy at lower price. We need to find a new equilibrium. Will we find it this year? I'm not sure, but
I got to say, and you know, I've heard a lot of criticisms, and these come from mostly public equity investors, I will admit, but basically saying that, look, it's just this mirage of low volatility because private equity isn't marked to market. Is there any truth in that they should be behaving with, you know, bear market in public equities, that the private world should be that bad? It's just this, you know, illusion. Again, not my words. It's some of these portfolio managers saying this.
Listen, the mark-to-market provides an element of discretionality of how down you want to market your asset. But at the end of the day, LPs are becoming much more savvy and they scrutinize this valuation with a bigger lens. Now, keep in mind that there is a major difference between private and public market valuation. This PE owns assets for 3 to 5 years, so they can afford a blip. So they can afford the cyclical downturns because the exit is going to come later. And this is very different from public market where you tend to go in and out much quicker. So I think part of it is justified by this.
Yeah. Is there any point when we're looking at a world where Fed, ECB, pretty much everyone, perhaps save for Japan and China, is looking at raising rates, where the strategy of being funded by cheap money, doing deals with major leverage, saddling up companies with debt, that sort of model of private financing ceases to work, or at least ceases to work in the manner that it has over the past decade?
I would argue that this model has ceased to work already because of competition. Now, remember, private equity was an industry where it was all about financial engineering when it was born. You buy an asset, you put leverage, you increase a bit your EBITDA, you sell, you make money. But competition meant that in the last 5 to 10 years, all the PE had to develop operational expertise, had to focus on add-on acquisitions and doing more. So I think they're better equipped today than they were when the global financial crisis happened to deal with it. But I agree with you. When you look at the last 5 years, most of the value creation has been multiple expansion. I mean, some study prove it's more than 50%. This is not going to happen for the old vintage. For this new vintage, I think there will be fantastic opportunities once the valuation will realign.
Simona, we're going to have to end it there, but I love it, ending with a little bit of optimism. It's something we definitely all need right now. That's Simona Mailare, co-head of UBS Alternative Capital Group. Now let's get to your Bloomberg Business Flash. With that is Leanne Gerrans. Good morning, Leanne.
Gazprom says it will halt gas supplies to French utility ENGIE because of a disagreement over payments. The Russian company accuses ENGIE of not paying in full for July deliveries. Meanwhile, European Commission President Ursula von der Leyen says the EU has met its winter gas storage goal 2 months ahead of target, with reserves now at an average level of 80%. China's factory activity has contracted for a second straight month. The official manufacturing PMI was higher in August, but at 49.4 was still below the 50 level that separates expansion from contraction. The world's second biggest economy has been hit by power shortages spurred by a historic drought, a continuing property market crisis, and also COVID restrictions. And Snap is said to be planning to lay off around 20% of its 6,500 staff. According to the tech website The Verge, the social media company which owns Snapchat is going to start the layoffs today. The report says the team working on minis, small applications made by third parties, will be among the most affected. And that's your Bloomberg Business Flash. Danny.
Leanne, thanks so much. Coming up, 2 Wall Street banks ditched some of their last remaining COVID protocols, laying the way for return to office. That's next.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China. But African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, of the US, Europe and the UK, have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Goldman Sachs is lifting some of its final COVID rules, including vaccination requirements. The New York Post says it's seen a memo ordering staff back to the office 5 days a week. It follows a similar move by Morgan Stanley. For more on this, we're joined by Bloomberg's William Shaw in London. So, Will, what changes exactly are Goldman and Morgan Stanley making to their return to office policies?
Well, it looks like the Wall Street pandemic era working culture may be coming to an end. Goldman Sachs has told its staff outside of New York that they can re-enter the offices regardless of whether or not they're vaccinated. In New York, they've said that staff with a medical or religious exemption to the vaccination mandate will be able to enter without testing or face masks. Morgan Stanley have got something similar. They've told their New York staff that it will end its test and control measures, including exposure notification emails. So those processes that were in place are starting to be wound down effectively.
So when it comes to Goldman, I mean, are we essentially back to the pre-pandemic era type of arrangements? Where does the firm stand?
Well, Goldman have always been very bullish about people going back into the office. Earlier this year, they told staff that they'd be ending their free breakfasts and free lunches at the office, a perk that some firms have been using to try and persuade people to come back in during the pandemic era.
Ain't no such thing as a free lunch. Will, this might be a little bit cynical, but especially in this day and age, I think it's relevant in terms of, workers' calculus of whether to go into the office, whether to stay at home at a time when energy bills are soaring. What does that look? Does that push people to get back into the office when they're looking at a winter where heating is particularly expensive?
I mean, I think that's very relevant, isn't it? I mean, workers will be thinking, like, on the one hand, gasoline prices are very high at the moment, and the cost of living means that public transport is expensive. They'll be asking themselves, is it worth spending that money to go into the office? At the same time, to think about it from quite a grim perspective, as it starts to get colder, people might start to think, well, am I better off going into the office in order to get the free heating? On the other hand, like, banks will be conscious that the employment market is not what it was like pre-pandemic, and there are a lot of fintech companies out there that are offering high salaries and the opportunity to work at home 5 days a week. If people are prepared to jump ship from big established banks. So it's quite a nuanced calculation. I wouldn't necessarily gamble on workers flocking back as an overwhelming majority based on these measures that banks like Morgan Stanley and Goldman Sachs are taking.
Yeah, I mean, totally fair. Well, all of this in the context of an extremely tight labor market in the U.S. and elsewhere. Well, thank you so much. That's Bloomberg's William Shaw giving us the latest on the big banking giants. Now, as we close out the hour, we are looking at equities unable to hold on to gains. The future session for Europe started out strong. Still some resilience in the U.S., but that has been fading as we get closer to the open. Nat gas prices continue to spike. We'll continue the conversation on Bloomberg Surveillance Early Edition in the next hour. This is Bloomberg.
Back and looked, and very few secretaries of state in the last 100 years, or maybe ever, have really gone back into government. So why did you want to come back into government for any issue when you've got 8 grandchildren, you've got 2 daughters, you've got wonderful family? Why did you want to come back and go through this terrible process we have in Washington of getting things through consensus and getting people to agree to what you want to do?
Because I want those grandchildren to have a future. It's very simple. We're not on a good track right now. The world is not serious enough about reducing our emissions fast enough, David. And the result is that the planet is going to continue to evolve in reaction to what we human beings are doing to it, mostly through fossil fuels. Most of the emissions that are going up nowadays into the atmosphere and are creating this increased level of energy that comes from the ocean, goes into the storms, the floods, the rain. All of it is explainable, and it's all linked to the changes we are creating on the planet. So it's very simple. I wanted to come in because I think we have a real chance now to make something happen, and I think Glasgow was a major step forward in the effort to do that.
The difference between political gossip
and policy intelligence. Bloomberg Government provides our clients with expert reporting, analysis, and public affairs tools that give you the edge in reaching policymakers on the Hill. When you're in the business of influence in Washington, information and connections are the currencies on which you rely. For knowledge you can act upon, the difference is Bloomberg Government.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I'm paying attention to what the Fed is telling us.
I think you are fighting the Fed if you're bullish. It's hard to find anybody that's bullish now.
I think the Fed will be able to control a massive downward ascent.
The next 3 to 4 months through the rest of this year, it's going to be a really volatile time.
You have to be opportunistic. You have to be patient.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Two of Wall Street's best-known banks tell employees it's time to return to the office. Goldman Sachs and Morgan Stanley clear the way by lifting some of their final COVID restrictions. Job cuts are reportedly on the way at the parent of Snapchat. Snap is said to be laying off almost 20% of its nearly 6,500 employees. And more revelations about classified documents found at Donald Trump's Florida home. The Justice Department suggests there may have been attempts to obstruct the investigation. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kriti Gupta in New York. Kaylee Lines is off today. And Kriti, in terms of the market response here in Europe, it seems a gas gloom once again descends, but US futures point a little higher.
Just a little bit higher. But what's interesting is in Asia, that wasn't exactly the sentiment that we've really ended the Asian session with. In fact, we actually ended, if you look at the MSCI Pacific Index, higher by 0.2%. But Anna, I wouldn't call it by conviction by any measure. In fact, if you look at the Nikkei, which I think is really where a lot of the sentiment crosses into when you look at Europe and then ultimately the Asian session as well, it was actually ending the session down about 0.4%. Remember, those stocks are largely going to be tech-based as well. So if we're looking for some sort of indication on where exactly some of the tech stocks, for example, that, by the way, you need on the S&P 500 side to really make your bull case, where they're heading in today's trading session. Well, based on Japanese trading, you aren't actually going to see that much help on the equity side. But I really want to look at the currency market. As Matt Miller pointed out yesterday, I do love my FX. So let's go there here, because as we talk about still a hawkish Federal Reserve, a lot of these emerging markets are still struggling when it comes to their currency base. And I really like to look at the Indian rupee. We don't do that often on this show. We talk about the yen, for example, or the Chinese yuan, but the Indian rupee circling that key 80 level, and that's going to be significant as we talk about just how much weaker it can get and just how much the Reserve Bank of India can actually do to stem that weakness. And on the other hand, the Chinese yuan, well, it is coming out stronger. The PBOC actually fixing it higher than expected for many, I want to say the 5th or 6th straight session that we are seeing for a while here now, Matt.
I think we should start looking at the rupee more, as we now have Gautam Adani in the top 3 richest men in the world. We'll talk about that a little bit later. Take a look at S&P futures right now. They are unchanged after the drops that we saw really the last 3 sessions in a row. Friday was the big one, of course. Monday was a little bit tepid. Yesterday, a bigger drop again of about 1%. So now markets are trying to decide which way to go. In terms of the 10-year yield, it's up right now as investors let go of those bonds, but only by almost 3 basis points, 31.3 as a pretty high level, 313, 312. And you see the Bloomberg Dollar Index coming back up a little bit. It had dipped down, but now at 1297, we're back in the 1300 territory. So we're getting back closer to those all-time highs that we last saw in July. And then Bitcoin right now rallying up about 1%, and it's holding just over $20,000 at 20,200 and change. And so maybe that is a positive sign for the U.S. Open in 4.5 hours from now. What do you see in Europe?
Yeah, just as you were talking there, Matt, the S&P futures picture then just dropping into negative territory, only marginally, but clearly undecided, as you say, about where to head. And we have a pretty undecided picture here in Europe. It's negative, but we had gains earlier on, so we've given up those earlier gains and fallen into the negative path. So the FTSE 100 down by 0.9%, the CAC 40 down by 0.8%. We're all about inflation once again, an inflation watch. Euro area August consumer prices rising 9.1%. That data just hitting the Bloomberg terminal. 9.1% is a little bit higher than the estimate of 9%. And so that paints an interesting picture about inflation story here in Europe that's coming in above estimates. So economists still lowballing those estimates about where inflation is, and that the actual numbers are beating. And these numbers are actually coming in higher than prior readings of inflation as well. So no sense that we've peaked on that inflation picture overall in the Eurozone. What impact is that having on the euro? And this is interesting because we were just above the 1 level on euro dollar before that data hit, and the market has taken this as a negative. So the market is not thinking, well, that means more hawkish ECB, let's buy the euro as a result. The market is thinking this is bad for the Eurozone economy and selling the euro, it seems to me on first glance. Natural gas prices are also an area of concern for Europe today. This is day one of a 3-day shutdown of Nord Stream 1. It was planned, it was pre-announced by the Kremlin. They say it's for maintenance. European leaders doubt that. But the big question is whether the gas gets turned back on. And we've had a lot of conversations about storage and how Europe weathers, of course, the winter. So natural gas prices jumping a bit this morning. Brent crude down another 2%. We had a $7 range on oil prices broadly yesterday. Quite a big range of movement and a big move downwards on news flow coming through from Iraq. But we're cautioned by some of our colleagues not to read too much into that big move lower yesterday because it is the end of August. But Brent crude now substantially below 100 at 96.94. And I put in Drax Group, a power business in the UK. There's further talk once again about whether the windfall tax on oil and gas companies will be extended to power generating businesses which have been making big profits, Chrissy.
Yeah, Anna, at its heart, it really becomes and remains a commodity story. Let's see how long that really lasts as well, which brings me to what we're looking at ahead today. As Anna mentioned, and worth bear repeating, Russia's Gazprom stops delivering natural gas to Europe through its main pipeline, Nord Stream 1, for 3 days of maintenance. The shutdown will likely further squeeze energy supplies. And the ADP's National Employment Report, a staple of U.S. labor data ahead of the government's payrolls release, will end its month-long hiatus today. The revamped report will have updated methodology and a range of wage data as well. And this week's Fed Speak continues with remarks from Cleveland Fed President Loretta Mester, Dallas Fed President Lori Logan, and Atlanta Fed President Raphael Bostic. Matt?
All right, let's get to some bank news. And by the way, I note just now coming across the Bloomberg terminal headlines that J.P. Morgan's Frankfurt offices were raided as part of the CumEx tax probe that has been ongoing for years. But just to point out, there's that raid to keep in mind in Frankfurt. Back here in the U.S., 2 of Wall Street's best-known investment banks say it's time to come back to work. Goldman Sachs and Morgan Stanley are removing some of their last COVID restrictions after the Labor Day weekend. Sonali Basak, our global finance correspondent, joins us now. So, Sonali, is Goldman Sachs an outlier when it comes to these banks? Morgan Stanley, I guess, now joining the team.
Yeah, when you look at what Goldman's communications to employees it was about COVID. It was not necessarily about return to work. However, the tone from the managers has certainly been that beyond what we've seen in the most recent communications. They were one of the first firms to bring people back to work. But when it comes to coming back to work, if you look for what the Partnership for New York City has said, about 40%, less than 40% of employees in New York area have been coming back to work. So yes, Goldman has been an outlier in that way. They were much earlier to bring people back to work. And as far as easing COVID restrictions goes, they really are following the CDC guidelines, the idea of significantly less severe risk of illness. And also these rules do vary across the banks. For Morgan Stanley, the isolation rules after being exposed are different than they are at Goldman slightly in terms of how they've communicated to staff. I would also say the vaccine requirements have changed for these banks, and Goldman cites New York's vaccine mandate, so really they're following the regional rules here as well. So there's 2 things going on here at the same time, both this idea around COVID and restrictions easing, and the idea that Labor Day is right around the corner, and this is a tough economic environment ahead, and people are expected to come back to work.
So that's the story from the corporate angle, from the bank side. How much anxiety is there really from the banker side as they're being asked to come back in?
Listen, a lot of Wall Street business lines are down significantly, and so that means that there is a lot of pressure for employees to be back at the last part of the year. And the businesses that are performing well, like trading businesses, and even in some ways M&A businesses, there is an expectation that market share gains are equally as important at this point in time. Remember, there have already been significant pressures on compensation expenses. In the first half of the year alone, you have Goldman cutting compensation expenses by $3.5 billion compared to last year in the first half of the year. So the banks have already said that they are keeping a clamp on expenses. They have already said that they are probably going to be subject to the same annual culling that they've seen in years prior to the pandemic. That can be about 5% of a workforce, and not just at Goldman Sachs. But the question is, if the environment becomes worse, does that 5% become 10% or even greater at some of these banks?
All right, Shonali, thanks very much. Shonali Basak there, our Wall Street reporter covering the banks for us this morning. Now, shares of Snap on the other coast are falling this morning, according to Verge. The parent of Snapchat plans to lay off about 20% of its nearly 6,500 employees starting today. Joining us now for more is Alex Webb of Bloomberg Quick Take. So, Alex, first of all, Snap specifically, before we get to the broader industry and the broader labor market, why are they doing this?
Snap's had a particularly torrid year. It missed the market's estimates for its earnings in the most recent quarter. So The Verge is reporting it. It was clear that they were going to have to do something. They would have to perhaps cut some jobs. So Verge is now reporting they're going to cut, as you say, 20% of their workforce. That equates to somewhere between 12 and 1,300 employees. They've been piling quite hard into hardware. You know, they made a drone which can take photos. They cut that product. It seems as though those are the things that are being tamped back on. You know, the shares are down 90% from their 2021 peak. Company's now valued at about $16 billion. So it was clear that some action was needed.
And Alex, we've heard talk of job cuts in other parts of tech, but is it the case that Snap will feel the pain more keenly than other big tech names?
The problem that Snap has is that it is a lot smaller, particularly than Facebook. Facebook has something in the order of 2 billion daily active users. Snap has just 300 million. Facebook has $120 billion annual revenue. Snap has just 5 billion annual revenue. So it's got far less wiggle room than some of those other big companies. And if you look at where the competition is coming right now, particularly TikTok, it is targeting very much the demographic that Snap has been targeting itself. Those young users, 18 to 25-year-olds, sometimes just teenagers. Now, these moves could save something in the order of $250 million, but Snap, for all its 5 years as a public company, has never been profitable on a net or operating basis. So it is therefore got far less wiggle room than a Facebook.
All right, Alex, thanks very much. Alex Webb there, Bloomberg Quick Take, talking about the job cuts at Snap, especially interesting when you consider just yesterday we had JOLTS data showing that job openings rose back to almost a record 11.8 million. So we still see job cuts, though, in tech. Now, the Justice Department says White House records held in a storage room at Donald Trump's Florida home may have been moved before an FBI search in June. Officials say that could have been an attempt to obstruct the investigation. Jack Fitzpatrick, Bloomberg government reporter, joins us now from D.C. with more. Jack?
Yeah, so the issue here is that there was a significant back and forth between former President Donald Trump and his lawyers and the National Archives and the FBI well before the August 8th search of Mar-a-Lago that is in question that they had the search warrant for. A big back and forth was in June in which the FBI visited Mar-a-Lago, and Trump's lawyers had said they were responsive to all the relevant requests for top secret and SCI clearance level documents. And then, of course, on that August 8th search, at the FBI said they found about twice as many documents that Trump's lawyers had said were already turned over if they were relevant to that search. So obviously it gives you a sense of the scope that they found quite a bit, which the FBI had already said, but also the fact that there seems to have been some attempt to either hide them or at least some dishonesty with the FBI about the former president's lawyers' willingness to cooperate.
And Jack, on to the current administration. President Biden has criticized Republicans for joining in rhetorical attacks on the FBI following its search of former President Trump's Florida residence. Biden was speaking yesterday in Pennsylvania. Let's listen.
It's sickening to see the new attacks on the FBI, threatening the life of law enforcement agents and their families for simply carrying out the law and doing their job.
Looking ahead, Biden plans to deliver a primetime address tomorrow in Philadelphia. What do we now expect, Jack?
Well, you could see basically the focus that the president is taking on the campaign trail about these issues in last night's speech. His Philadelphia speech upcoming is supposed to be about democracy, and I mean, that's the way the White House has described it. But even the policing issues, that speech yesterday that was supposed to be about support for police, sort of intertwined the issue of local police funding with the FBI. You know, the key line, I think, was when President Biden said, "I'm opposed to defunding the police. I'm also opposed to defunding the FBI," really hammering Republicans for not standing by the FBI during or after this search of Mar-a-Lago and everything happening around former President Trump, but also trying to campaign on support for the police. So it's you know, a lot of the time midterms focus on the state of the economy under the president. In this case, the president is pretty aggressive going out on the campaign trail, supporting John Fetterman, supporting Matt Cartwright in a competitive race, and making policing a significant issue. And I think we'll hear more of that in Philadelphia tomorrow.
Certainly something we're going to be looking forward to. Jack Fitzpatrick of Bloomberg Government, we thank you as always. Now let's take a look at some of the stocks moving in pre-market trading in the United States. Snapchat is something we have, of course, already discussed with Alex Webb, but it's worth looking at once again because it is actively moving the shares. You do actually see shares down to the tune about 7% in light of those job cuts, and this is significant as we start to see a lot of these tech names, and I want to say big tech as well, although Snapchat perhaps doesn't qualify under that name, starting to make those massive cuts, and it really has to do with the story of preparing for recession. And with that story comes HP as well. Actually was starting to reduce their profit forecast as those PC sales continue to slide. The idea here simply being that in a recession, it's not just about the consumer, it's about business investment as well. And right now, HP shares are under pressure to the tune of about 6.8%. Once again, if you don't have that business investment on your side, they're cutting back, they're preparing for a downturn. What does that say for the rest of the economy? Not good news. At least that's what we're getting from HP results. And at the end of the day, we have to also look at that retail base, checking back in on Bed Bath & Beyond shares rising ahead of that strategic update. Those shares are up about 1.6%, but once again, this is not in line with the over 10% move we saw in yesterday's session. Will it actually sustain, given perhaps some risk-off indicators in the broader market, Anna?
Chrissy, coming up on the program, we'll talk to Mark Haefele, UBS Global Wealth Management Chief Investment Officer. We'll get his perspective on the Eurozone economy for sure, but also on global investment approaches, the logic of fighting the Fed or not. And credit markets may be underpricing the risk of recession. We will deep dive into the credit markets. A lot to look ahead to in September, of course, in that market. Plus, Shell's botched $1 billion oil cleanup. How mismanagement, waste, and lack of transparency are making a pollution hotspot even worse. Read more in today's Big Take story. You can look at that online or by typing NI Big Take into your Bloomberg terminal. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Last month's jobs report caught everyone off guard.
This is quite a surprise. Oh my, as Dick Enberg would say.
That is a wow statistic.
That recession talk just got a freezing cold shower.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
It's good news, bad news, good news.
They're walking that fine line.
We still have a large gap between jobs and workers, but at least we're moving in the right direction.
The market has 2023 wrong.
The August jobs report, Friday on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kriti Gupta here in New York, Anna Edwards out in London. And for those of you listening on radio, I've got a chart here that I'm showing our TV viewers. You should really check out when you get to your offices and log in. The terminal number is G#BTV2493. I just think it's an amazing chart, and it's connected to so much volatility in the commodities markets and leaving many Europeans and some Brits breathless. We're seeing a real drop in the amount of gas supplied to Europe. And this shows Nord Stream flows, Turk Stream supply to the EU, and Ukraine transit. It's pretty dramatic. Joining us, Ksenia Galushko, Bloomberg Equities editor out of London, to talk about how this has affected markets through inflation and really driving up cost of living and making things more difficult for Europeans.
Absolutely, Matt. I mean, this will be in focus for the rest of the year, if not the next 12 months. The fact that Russia is reducing gas supplies to Europe is not bidding well for this upcoming winter. And while major countries like France, like Germany, are now preparing for a drop in gas supplies, at the same time, this is surely going to drive up energy prices, and this is only going to bump up inflation and also weigh on consumers who are already facing a consumer crisis.
Yeah, and Ksenia, we've already seen no let-up in the inflation story across the Eurozone with that data out just this morning. Let me ask you about the broader, well, let's go to the US economy and how data is being received by markets, the market mentality, I suppose, because it's interesting that JP Morgan has a note out saying that they see, strategists there see a bullish stock signal in US jobs data. I assume they're not talking about the JOLTS numbers of yesterday because they were not taken well by risk assets.
Absolutely, yes. So they're actually talking about jobless claims, and JP Morgan strategists are very much contrarian to the rest of Wall Street strategists. So both Morgan Stanley and Bank of America say that the Federal Reserve will remain hawkish and earnings are said to drop from here. So they are much more cautious, and they say that the sell-off in equities that we saw in the first half of the year will continue, pairing the rally that we saw during the summer. So JP Morgan is very much an optimist and almost a sole optimist among major Wall Street strategies in that sense. So we'll just have to see what the Federal Reserve does in September and also how earnings react in the next 12 months.
Yeah, it'll be really interesting to watch the link then between this jobs data and the way the risk assets perform. Ksenia, thank you very much for joining us. Ksenia Galushko joining us there with market analysis. And for more, you can check out the Markets Live blog. MLIV Go is the function to use on your Bloomberg terminal. This is Bloomberg.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
We will never break. We will never break. Build on a foundation strong enough to stay. We will never.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Now, keeping you up to date with the news from around the world, here's the first word. In Frankfurt, German prosecutors have raided the offices of JP Morgan. It's part of their investigation into the controversial cum-ex scandal that cost taxpayers billions of euros. JP Morgan says it continues to cooperate with the authorities. Cum-ex was a trading strategy that siphoned off at least $10 billion in tax revenue. And Mikhail Gorbachev is being remembered as the last leader of the Soviet Union who ended the Cold War. Gorbachev died Tuesday at a Moscow hospital. He was 91.
Nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you've really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, We are seeing more and more people say, I have to worry about me as a person. I have to worry about my family. I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
The top names at the Fed are on Bloomberg.
It is essential we get inflation down. People want jobs, but they also want low and stable inflation. We have to give them both.
Nobody covers the Fed like Bloomberg, your global business authority.
What is your base case for Italy in terms of what happens politically and what the economic fallout is?
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Two of Wall Street's best-known banks tell employees it's time to return to the office. Goldman Sachs and Morgan Stanley clear the way by lifting some of their final COVID restrictions. Job cuts are reportedly on the way at the parent of Snapchat. Snap is said to be laying off almost 20% of its nearly 6,500 employees. And more revelations about classified documents found at Donald Trump's Florida home. The Justice Department suggests there may have been attempts to obstruct the investigation. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kriti Gupta in New York. Kaylee Lyons is off today. And Matt, European equity markets giving up on early gains. US futures, last time we checked them, pretty undecided. How do they look now?
Yeah, they were very unchanged, and frankly, they haven't moved that much, although they are to the downside, so in the red, just about 0.1% on S&P futures. But recall, we've had losses over the last 3 trading sessions. It'll be interesting to see if we stick to these losses. Of course, we still have about 4 hours until the U.S. Open. The 10-year yield starting to rise right now as investors sell off that debt. Also a fairly small move, but to a significant level, 3.13 on the 10-year. Nowhere close to where we see the 2-year, of course. That's about still 40 basis points away, but it is moving higher. The Bloomberg U.S. Dollar Index, really interesting because it had come back up almost to an all-time high last week, and now you can see it's coming back there again, 1297. So 1300 was the level we were flirting with, I think, on Monday, and we had come off that significantly. Maybe that's safe haven, maybe that's confidence in the U.S. economy relative to other economies. And then Bitcoin right now, also not moving very much, but holding just above $20,000. So that's significant, I guess. To some people, it's a big round number, 20,190. I feel like people are paying less attention. Is that wrong of me to say, Kriti, that people are paying a little bit less attention to Bitcoin?
I mean, it feels wrong coming out of your mouth, but
yeah.
it is, I think, a little bit true. When you look at it from a volatility-adjusted basis, it's only moving, 1-2% on a daily basis. You look at that historically, it's usually a 4% move. So maybe, Matt, but I would argue that the biggest theme this week is going to be payrolls that you're going to see on Friday, perhaps stocks in a little bit of a wait-and-see approach. That story gets even more interesting in light of the news we got out of Snapchat. Those job cuts are coming fast and furious. They were in big tech. Now they're going to perhaps the more tech-adjacent sectors. Snapchat really the poster child for that this morning. Shares are down 7% reacting to that story. But really at the end of it, it becomes a question of business investment. That's where HP is concerned. They're actually revising their forecast lower when it comes to PC sales, and that is not, of course, going to be good for their bottom line. So those shares reeling a little bit, Anna, down about 7% this morning. But there is some good news in the market, some pockets of green here and there, and Bed Bath & Beyond is going to be a key metric for that, up about 2%. And of course, remember, they are waiting for that strategic update to come out, and on top of that, you have the retail base really vying for them. So let's see if that is a sustainable move this morning, Anna.
Yet another day of the Bed Bath & Beyond story, it seems. Kriti, this is what the European picture looks like right now. We've got European stocks down by 0.9%, giving up on those early gains, as I mentioned earlier on. Interesting to see the inflation data out for the Eurozone a little bit earlier on, and it was a little bit above estimates, which is not what the market wants to see, really. The market asking questions about when inflation peaks, and it seems we may have not got there, or at least we haven't already seen a peak in Eurozone inflation, we could say. So we continue to digest that latest inflation data out of Europe, and it's interesting to see the way the market has taken that. The euro had rallied quite strongly in the last couple of days on hawkish commentary from various ECB officials at Jackson Hole and then back here in Europe as well. But the market giving up on some of those recent gains in the euro in the wake of that data this morning, perhaps thinking that actually the fight against inflation is going to weigh on growth. We've got natural gas prices also moving this morning, up by 2.2%, and this is also something that could weigh on growth, of course. Ongoing focus on energy. We've got day one of a 3-day shutdown of the Nord Stream 1 pipeline. This was well flagged by the Kremlin, so this is happening as expected. They say it's for maintenance. European leaders doubt that, and the question is whether that gets turned on afterwards, of course. Brent crude really in focus this week. We saw a substantial drop in oil prices yesterday, and today we're at 96.10 on the Brent price, down another 3%. We're cautioned by some of our colleagues, though, to think carefully about what that means. Well, given that we're at the end of August, perhaps the volume's not too meaningful. Let us talk about where we are on markets, and in particular, I want to focus on the European story. Mark Haefele, UBS Global Wealth Management Chief Investment Officer, joins us now. Mark, very nice to have you with us. Let me start with thoughts on the Eurozone and the fight against inflation, given that another high print on inflation, 9.1% for the Eurozone. What does this mean for the ECB in your calculations?
Well, I think you summarized it well, that there's been tough talk, and we expect they'll do another 50 basis point hike and then maybe some 25 basis point hikes. But as they've acknowledged, that could come at the expense of growth in a very difficult situation. And I think that's why you're seeing that play out in the euro the way it is.
I wonder what you think about the central banks all raising together. It seems to have pushed markets back down on Friday in a big way in the last couple of sessions. And now the S&P 500 is below 4,000. Do we keep heading down into the end of the year, Mark, or can we recover some?
Well, you know, in our base case, we finished the year around here, maybe a little lower in the S&P 500. And some of that, you know, we can bounce around, but I think that some of this is going to be how much of the slowing growth that we're seeing in some metrics plays through to earnings. So there's no question that several central banks have driven this narrative, but into the back end of the year, it's likely to be a little bit more focused on earnings.
And, well, that was my next question, so I'm glad you went there, because earnings surprised a bit to the upside in the last earnings season. Of course, they always do, and not as much to the upside as they typically do. Do analysts need to lower the bar further as interest rates rise? Is that going to hamper investment and crimp margins?
Well, you know, since we don't think that the market into the end of the year is going to go a lot higher from here, yeah, we have some concerns about where the sell side is on earnings. But I also think that, you know, there are some signs that potentially some sectors could do better. For example, you mentioned energy. I think for us, you know, where those stocks are trading, and given the supply-demand picture that we think is going to evolve into the back half of the year, that would be an interesting sector.
Well, Mark, let's talk about that sector story a little bit more with the tech angle, simply because you have to have tech on your side for that really bull case to emerge in U.S. equities. It's kind of like, as Matt pointed out, they were getting these kind of A-pluses on earnings, then they got an A-minus, and the market really punished them for it, but they are still getting perhaps that A-minus grading. I'm wondering why that's such a negative for the market at a time when perhaps there is a little bit of that there is no alternative TINA approach coming back.
Yeah, so we would not be overweight in tech here for two reasons. First of all, you know, the growth is slowing a little bit, but these are growth stocks, so they're supposed to be growing a lot. So there's valuation pressure there. But secondly, you know, that is really down to central banks, and people, we believe, are underestimating what the Fed may do in terms of the number of hikes it may do. And of course, those higher rates impact these longer dated payouts in, you know, tech, where the earnings are way in the future.
And what does that mean? And we're talking about the rate story, but what does that mean when it comes to quantitative tightening? I believe tomorrow is the day where you have the run rate actually doubled to about $95 billion per month. Do you actually expect an active change when it comes to the plumbing of the market or the liquidity story in the back half of the year? How impactful is that?
Well, it's a great question that we debate all the time. I think that, you know, the good thing about it is it's something that the Fed is looking at very closely as well. And we believe that because they're looking at this closely and they have a lot of problems on their plate and they can control this problem, we think they're going to titrate that effectively so that it doesn't become a major issue. But it is this black box. It's something that nobody has really seen before. And so it hangs on the market a little bit as a risk factor.
Do you think that, Mark, do you think volatility is going to be something that's with us for a while as a result of, well, in your view, the market underestimating how tough the Fed is going to have to be with rate hikes around inflation? Is that going to continue to create volatility?
Well, there is going to continue to be volatility because, 3 data points in a row are a new trend line. And we've got lots of noisy data like CPI, core, and headline. We've got the jobs data. So everybody's really trading on all these different data points. So we expect a lot of volatility ahead in equity markets as everybody tries to answer the major question, which is how much of this inflation is due to supply chains and how much is simply all inflation is at the end of the day a function of monetary policy and too much money sloshing around in the system.
How do you measure that? I mean, I'm looking at the VIX here. If I just pull up a 5-year chart of the VIX, it doesn't look that volatile to me. Is there a better way to measure volatility, Mark? Because obviously we all see these prices going haywire. One day it's gas prices are rising the most that they ever have, and the next day they're slumping like 20%. So how do you measure volatility?
Well, that's a good question, right? In the sense that I think there is a very acute volatility, VIX, where people rush in to buy protection, and we get these, we've got a history of the Federal Reserve and other central banks effectively suppressing volatility until we get a major spike in VIX around some crisis or something. And I think it's right that it's a little bit different what we're saying going forward, which is with the Fed taking these actions, we're going to have a little bit more maybe day-to-day volatility, and then also periods where the market moves up and down as we start to formulate these trends around is the data getting worse on inflation or better. So I do think that with the central banks now hiking, kind of the way we think about volatility may change.
Mark, thanks so much. Thanks for your time. Mark Haefele of UBS Global Wealth Management. Thanks very much for joining us. Still to come on this program, are credit markets underpricing the risk of recession? We'll get the latest insight into that question. Think about a busy time ahead or not, perhaps, through September for credit. That conversation next. This is Bloomberg.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition, and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. all to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
This is Bloomberg Surveillance Early Edition. We are simulcast on both Bloomberg Radio and Bloomberg Television. Kriti Gupta with me here in New York as Kayleigh Lyons is out, Anna Edwards out in London. Now, credit markets are underpricing the risk of a recession. That's the latest concern from both UBS and TD. Current corporate spread levels imply a 25% chance of a recession, while UBS sees a 55% chance. Joining us now is Bruce Douglas, Bloomberg team leader for high yield and leveraged finance. And despite this, Bruce, there is so much action in corporate credit right now with a ton of issuance due next month. How do you read the story?
Yeah, well, I think, this month is going to be absolutely crucial. September is always a key month for the credit market. And this year, arguably, it's even more crucial than ever, given the sluggish year we've had to date. In the US, there's one massive deal, Citrix, a $15 billion deal, which is currently underway. And I think that all investors are watching that to see how it goes. Can it be sold down? And that will provide a key indication as to the corporate credit markets going forward, not just for the US, but also for Europe.
Right, and so that's going to be a really important test of risk appetite or appetite for this type of debt at this time then, Bruce. What about the extent to which credit markets are pricing in recession or not? Because that's why UBS is saying, well, they're concerned because they say that the rates at the moment imply a 25% chance of recession, and they say credit markets should be taking that threat more seriously. What do others say?
Well, I think that we saw a rally in August, which in July and August, which is now coming off the boil. We've seen spreads rising again. And I think that figure, that 25% chance of recession, that's at this moment in time. But I think there's only one clear direction of travel for spreads, and that is up. And I think soon enough we'll see a correction in the credit markets, pointing to, I suspect, a greater likelihood of recession.
Bruce, I'm curious about the regional divergences here as we talk about a recession on the horizon for Europe specifically, perhaps even the United States, but certainly Europe, at least that seems to be the consensus at the moment. What does that mean in terms of issuance by European companies into the American bond market, Yankee bond issuance, for example?
Yes, well, I think that there will be, the US market is really, to some extent, the only game in town. I mean, we've seen a flurry of issuance this morning in Europe, and again, this will prove crucial to see how September's prospects go. But interestingly, the deal I cited earlier, Citrix, had a larger euro portion, but has now actually downsized that euro portion and is mainly in dollars. And therefore, for European companies looking to refinance, the US market is looking much more, looks like a much safer bet than the European market.
And everyone's focused on the Citrix deal. It's such a big issuance. I noted, though, that Siemens had an issue that was really well received, despite, the crunch in gas prices that are hitting especially German companies so hard.
That's true. Well, there is obviously a flight to quality taking place at the moment. Single A names are still likely to attract investor interest. And yes, the success of the Siemens sale yesterday demonstrates that there is still appetite for your blue chip European corporates. I think anywhere lower down the credit rating, companies are going to find financing conditions much tougher.
Bruce, thanks so much. Thanks for your thoughts. Bloomberg's Bruce Douglas joining us to talk about credit markets. Coming up on the latest episode of Peer-to-Peer Conversations, you might like to know, David Rubenstein sits down with the FTX CEO, Sam Bankman-Fried. That full interview premieres tonight at 9 p.m. in New York. This is Bloomberg.
material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. From servers to software to the cloud and beyond, HPE is transforming its business, and Tarek Robiati is central to the task.
Gone are the days where the CFO is just a scorekeeper. Our role as CFOs is to assist the CEO change the score.
Chief Future Officer, today on Bloomberg. Brought to you by Workday.
Bloomberg Green, bringing you the business, data, and innovators fighting climate change. Reinventing climate news on TV, Quick Take, and Bloomberg.com.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Matt Miller in New York and Anna Edwards in London. Kaylee Lines is off. Hewlett-Packard Enterprise, HPE, as it's known on the New York Stock Exchange, is one of the leading global providers of information technology solutions, and it's moving its entire portfolio to a cloud-based software model on the latest of Bloomberg's Chief Future Officer. HPE's CFO explained how that's changed his focus.
The ARR is critically important. The ARR is actually measuring the amount of our revenue that is locked in and recurring with our customer base. And to the extent that our ARR is growing fast, the more robust the future of the company is. And on GreenLake, we have to grow customers, we have to grow the revenue we make from those customers, and the ARR is the annualized run rate of revenue that you have from one period to the next. If your offer has a perennial future, it translates into a growing ARR. This is the way for us to truly understand that we remain relevant for our customers over the long term.
What about margins? When you hear from some of these analysts, these investors here, they're still dialed in on gross margin, some of the more traditional metrics?
Gross margin, for me, is the most important metric in our sector, right? It's fundamentally, if you think about our business, which comes from a hardware heritage moving into as a service, and with hardware commoditizing, you have to have a focus on gross margins. And as you can see from our results over the past 9-10 quarters, our gross margin have been expanding very, very solidly. That actually tells you that your customers are willing to pay a premium for what you have to offer. And so what you want to see is a combination of ARR with gross margin expansion, and the ARR composition becoming richer and richer with more differentiation thanks to software. That's the journey that we're on.
You can watch the latest episode of Bloomberg Chief Future Officer featuring the CFO of HPE tonight at 9:30 p.m. New York time on Bloomberg Television. Joining us now is Tom Keene, co-anchor of Bloomberg Surveillance. And Tom, big focus on the bond market today. I hear that your single best chart is on bonds as well. What are you looking at?
Well, I was channeling Abramowitz on this, and I stumbled on his chart. Sometimes, Matt, you stumble on a chart that just makes you stop. Let us sit on the failure of the bond market to provide return. This is the all-in Bloomberg Global Bond Index. Everything's in here. Everything in the kitchen's in here. And we are back on a price basis, Matt, to where we were in August of 2011. It is absolutely extraordinary. Wow. I just compared this, I don't have the chart, to the Morgan Stanley Global Index, and it's not even close. I mean, basically, bonds had a magnificent disinflation and had a 20-year move up to 2011, and then a little sort of kind of like, and we've rolled over to where we were 11 years ago.
It's incredible to me, Tom, that you know, your average sort of Joe Plumber six-pack pays so much more attention to the move in equities, but it's not nearly as significant. And I'm thinking of myself, you know, in that group, the lay person. Does Wall Street get the significance of this move?
Matt, you've got the money question of the morning. You are 100% correct. And I think what John Farrell, I, and Lisa have tried to do is explain to Wall Street, you got to start admitting there's a bear market in bonds. They've got this whole rationalization forward because 99% of them have never seen a bear market like this before. And the truth is, it is a massive bear market in bonds taking price on an all-in aggregate basis back 11 years.
Tom Keene of Bloomberg Surveillance, we thank you as always. Now let's take a look at what we are watching. We're specifically watching ADP numbers for myself. Of course, that is going to be the main theme of this week as we start to see the market's preference in wait-and-see mode ahead of payrolls Friday. That ADP report this time comes after it's been paused since the May data was released. The refresh in the way and the methodology of the way these numbers are counted is going to be crucial. It's not just about jobs anymore. It's about pay as well, Matt. I think that's going to be a crucial story ahead of Friday's jobs number.
I'll be paying very close attention to that as well. I noticed on Rich Go, Gautam Adani has become the world's third richest person, trailing Elon Musk and Jeff Bezos. And this is a name that a lot of people in the Western world don't know. It's also the first time that anyone from Asia has crashed into the top three. I think it's pretty incredible. He has a huge conglomerate that spans everything from coal, which is very key right now, to shipping, also something that makes a lot of money. So check out Rich Go, R-I-C-H Go on the Bloomberg terminal, and I think there's a story on him today as well. Anna?
Yeah, really interesting. I'm watching the European gas crisis ongoing as it is, facing perhaps a winter of rationing, suggests a 30% chance that this stream of gas does not get turned back on again. So that is the kind of reality that has to be considered here. And what does that mean for the winter? Germany acknowledging, Matt, already it needs to cut demand by 20% and find alternative sources.
Well, maybe the high prices are going to do that. I just think it's amazing how expensive electricity has become. It has pushed the cost of using EVs far above that of using gasoline vehicles.
Yeah, and there's an attempt now to decouple the price of gas from those electricity prices. More on surveillance. This is Bloomberg.
Successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer, like I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. To recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics? Ken Griffin is moving both Citadel and Citadel Securities to Miami. The scoop was broken by Bloomberg's Amanda Gordon.
I think in the next 3 to 4 months through the rest of this year, it's going to be a really volatile time.
You have to be opportunistic, you have to be patient, and you have to realize that this probably is going to go on for a bit.
The Fed is going to face an increasingly more difficult challenge this time around.
When they pause, you want to be very wary about the relief rally.
You are fighting the Fed if you're bullish. It's hard to find anybody that's bullish now.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
What a difficult couple of days. Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Futures down 1/10 of 1%. TK, the last 3 days, down 5% on the S&P.
It's really fragile, and some of it is just the distribution of that down 5%, the different sectors, John. The one shining light for not the bulls, but I guess the less bears, is the VIX really hasn't moved. John, the sweat that's out there, the August sweat that's out there says VIX 30. VIX is at 26.
We're playing off the data, Tom. Good news is bad news, apparently. Consumer confidence yesterday, job openings. They're moving in the right direction. Good news, bad news. The Fed's got to do a whole lot more. This market struggled.
We're going to wait for the data. We start to see that today with ADP. I don't know what to make of ADP, John. I just don't, I'll be honest, I just don't trust it. But there's a lot of data I do trust on, and it's in America, it's just where are we into September? I believe that's tomorrow.
Well, Lisa, let's start with the data out of Europe. Bad news is bad news.
Yeah, 9.1% consumer price inflation in the Euro region, coming in above expectations for 9%, really fueling these fears and these expectations of a 75 basis point rate hike, not by the Fed, by the ECB. And this is what we have to keep talking about. All of a sudden, we've reset expectations, not just for Fed rate hikes getting bigger than expected, but also over in Europe. And what does that magnitude, that sort of joint effort really mean for markets?
Have you seen how much the German 2-year has moved through the month of August?
First thing I looked at today.
Up 92 basis points, Tom. Lisa, that is unbelievable. Up to 1.2% from down in the 20s, 26, 27 basis points to start the month.
And it's not just there, and it's not just nominal yields. If you look at real yields, both in Europe and in the United States, they've risen to the highest levels since the heart of the pandemic, since the disruptions that really called the Fed into action. How much are we seeing a resetting that's been fully priced into the rest of the risk assets versus maybe not so much?
And this is why the equity market's struggling still this morning. Good morning to you. If you're just tuning in, we're down about 1/10 of 1% on the S&P. No drama on the NASDAQ, at least for now, up about 1/10 of 1%. Call it 0.2 of 1% higher. Yields higher again, though, up 5 or 6 basis points on a 10-year to 315.88. Euro dollar negative 0.4 of 1%, 99.76. Bramo, it's all about your world, the bond market.
Yeah, and this is how it really goes to the question you were asking yesterday and you've been asking all year, which is if the Euro region, if the ECB does raise rates by 75 basis points, is that positive or negative for the Euro? Right now, it is negative, and it is also because of the backdrop with the energy crisis. Today, the Nord Stream 1 is shutting for a 3-day maintenance. Maybe it'll come back online. Gazprom is halting exports of natural gas to Europe during this period of time. Will it come back online is the big question. In the meantime, you are seeing natural gas prices climb a little bit from the declines yesterday and the day before in Europe. The reason why they declined is because there was evidence that stockpiles were building faster than people had expected, but still, in my mind, this is the story heading into the fall. This could really shape what happens in Europe and, frankly, globally with respect to sentiment. 8:15 a.m. Tom, you were talking about the ADP employment change. They have rejiggered some of those expectations. You don't know what to make of them. I think it actually takes on more import, not necessarily because of how they've rejiggered expectations, but because of the JOLTS data yesterday, which was rather shocking. It was expected to go down. It did not. It went up. There were more openings that were posted, 2 openings for every unemployed American. This is not what the Fed would like to see. They want to see tightening. They are not seeing it. Today, perhaps we'll get some indication of how Fed speakers are really speaking to that, Tom. I think it's interesting.
There was a weak morning for research, but the keynote was the Alan Ruskin note on a beverage curve, and he says the U.S. is different, and it folds right into the JOLT survey, where you've got the idea that vacancies in America make us different, and maybe we won't see a higher unemployment rate.
Well, this is the dream for the soft landing, and we might get some more sense of how close or far. Speaking at 8 a.m., then we're going to be hearing from Lori Logan. I'm not as familiar with her. She is the new Dallas Fed president, and she'll be speaking at 6 p.m. And at 6:30 p.m., we'll hear from Raphael.
John, I'm lost. Didn't they just speak?
Who, Tom? Mester and Bostic?
The three of them. I mean, maybe Lori Logan didn't, but...
I think we met Lori Logan, Tom.
Didn't
on Friday,
they just speak like
Thursday.
3 cups of coffee ago?
I think we've heard from them a few times.
We've heard from them a
The
few
message,
times.
though, pretty clear, Tom, and I think that's the theme here for a lot of people. They have stayed on the same page, the same script, repeatedly, every single one of them over the last few days. John Williams as well, of the New York Fed.
To your point about the markets, look, the 2-year has just broken out to a new high, and with it, the yen is right up against new yen weakness. There's a tension out there. It screams August.
Very, very close to 350 at 349.29 right now. Christian Nolding joins us, Global Chief Investment Officer at Deutsche Bank Private Bank. Christian, we have taken out the June highs on a 2-year yield, and the question a lot of people are asking is whether this equity market has to test the June lows. Your thoughts?
Well, from our point of view, if you think from a growth perspective, we do think there is at least mild recession coming in the US, and there's also recession unavoidable for us in the Eurozone. And from that perspective, I wouldn't be surprised if equity markets go down a bit further from here. And we have been calling, saying the July uptick is a bear market rally, is probably not where we end. We've been arguing for buy the next dip, and I wouldn't be surprised if we see, if you look at the markets, is another 3, 4, 5, 6%, depending on the market's downside. I wouldn't rule out that we get there from our point of view.
Christian, what do you do with bonds? The chart that I put up earlier of price flat, yield, I guess, up a little bit. Global bonds on an aggregate basis are back 11 years. What do you do with that institutionally?
Well, from our point of view, it has been right to be short duration, and we kept it. So from that perspective, at least you can avoid to be super long duration as many investors sometimes have to be. I think that's number one. And then you really need to look at quality from our point of view. So you had discussed before, if there's a recession, what does it mean to credit spreads? I think we also need to look a little bit ahead, as we don't expect, at least in the US, a sustained long recession. Maybe it's 2 quarters, 3 quarters. I think if spreads are widening, there is an opportunity. If you look into investment grade, I would be a bit more careful on the high yield side from our point of view. We don't think these levels, which seem attractive, but from our point of view, is not where we want to go in right now.
Christian, is Europe a toxic place to invest in right now based on the energy backdrop and some of the volatility there? Or are you still seeing perhaps some opportunities even ahead of the U.S.?
Well, I wouldn't call it toxic place, to be very honest, but of course, it's tough to be very optimistic about Europe at this point in time. Let's call it like this. I think there are opportunities. If you think the ECB is doing quite a lot, as we do, we can imagine over the next 12 months, the ECB is moving from 0 now to 2, which is quite something, I would say. There is, I think, opportunities in European financials which could profit from that. But for the overall market, it depends really on the energy crisis and how the winter plays out to be. And from that perspective, it's not going to be easy for Europe the next months, I think.
Christian, did you just say that you're investing in European banks?
Yeah, I think European financials have upside because, as I said, if the ECB is moving, they can profit from a higher interest rate level. And from that perspective, now we are at 0, and I would expect the ECB not to look so much at growth because their target is really price stability, and to move up in increasing rates. And from that perspective, I think that would be positive for them, yes.
Christian, they're hiking into a recession. What's more important here, the rate hikes or the economic backdrop?
Yeah, but I think, recession, yes, but also here in Europe, I think it's not a recession which is a deep recession, which takes quarters and quarters. From that perspective, yes, there is some implication, and you have not seen a massive movement upwards, although the market is pricing some of the ECB hikes, not all. I think the ECB is doing more. And from that perspective, I think there could be some positives being overgrowth, looking at rate hikes from our point of view.
Well, that's a trade for the brave. Christian, thank you, sir. Christian Nolan there of Deutsche Bank Private Bank. Lisa Brambitz getting long European banks. I actually heard that from Sandlin Brown over at BNP Paribas a number of months ago, but that was at the June lows. It wasn't at the mess we're in right now.
Look, this has been the pain trade. There is an upside argument that matters, or the hiking that matters, and the currency market is saying it's the weakness that matters, because that is what the euro is responding to. And I really have to take some keys from that.
This is what the European banks have wanted, Tom, for a long, long time. They're getting it, though, in a very difficult moment.
John, you're being way too kind. Their performance has been absolutely irresponsible. It's at the board of directors level. I just looked at the chart for my good friends at BNP Paribas. Glad they support tennis. They've gone nowhere in 13 years.
75 basis point hike is the expectation, Tom, at the ECB now. Capital Economics out this morning, 9.1% CPI. And to Lisa's point, if you're looking at these banks right now, let's put it all together. TK's questioning the execution. Lisa, you're questioning the economic backdrop. Is rates enough to be supportive of stock prices for European banks?
Well, just take a look at what we've been hearing from all of the banks. Take a look at the capital markets activity. You're not getting the revenues from that because you've seen a massive slowdown, perhaps a little bit of a pickup in the rally, but otherwise IPOs, whether it's debt issuances, whether it's stock offerings, whatever it is all stopped. So then what is going to be the marginal driver? Okay, trading. Well, there it's kind of a little bit sketchy compared to where it has been traditionally because of how unpredictable it is.
Here's the marginal driver, John. Was it 3 cups of coffee ago that Bank A was moving 250 people into Asia?
Oh, yeah.
And now they're moving them out. And John, the guy that lives next door to you in that walk-up you live in was a SPAC banker. He's toast.
Lisa has picked up on the right theme. You mentioned Asia. You mentioned some of the banks pulling back on deals. Fold it into one story. Bramo, this is what the banks have got to do, pull back. Is it any surprise that Goldman and Morgan Stanley are now saying, let's go, let's go? COVID rules are gone. Get back to work in September.
And especially, it's not a coincidence that it's in tandem with the school starting. Right? Basically, it's like, okay, you guys don't have an excuse anymore. Let's go.
Last September, it was let's go, and then it was like, oh.
Maybe not. No,
we can't, maybe not. This September feels...
It's real.
Can I say it's real?
Yeah.
Can I say it's real, Tom? Is it real this time? Get to work?
See you in September.
Okay, that's nice. Who sung that?
Tom Keane did.
It's August.
That's that new song.
Put the banner up on radio.
Okay.
Put the banner up.
That was
It's
special.
August.
Sure. Futures unchanged from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Inflation in the Eurozone has set another all-time high. Consumer prices in the 19-country currency bloc rose 9.1% in August from a year ago. That beat the median estimate in a Bloomberg survey of economists, and it strengthens the case for the European Central Bank to consider a jumbo interest rate hike when it meets next week. The Justice Department says White House records held in a storage room at Donald Trump's Florida home may have been moved before an FBI search in June. The Justice Department says that could have been an attempt to obstruct the investigation. In a filing, there was a photo of files labeled top secret, said to have been found in the former president's office. The government was responding to his lawsuit to appoint a special master to review the documents. It's the biggest 2-year decline in U.S. life expectancy in almost a century, and it's blamed on the COVID pandemic. Life expectancy fell by almost a year in 2021 after a decline of 1.8 years in 2020. The pandemic has been directly responsible for more than 1 million American deaths. And shares of Snap are falling today, according to The Verge. The parent of Snapchat plans to lay off about 20% of its nearly 6,500 employees starting today. The stock already has fallen almost 80% this year. Snap has been struggling with a slowdown in advertiser spending. And Mikhail Gorbachev is being remembered as the last leader of the Soviet Union who ended the Cold War. Gorbachev died Tuesday at a Moscow hospital. His attempts to shake up the Soviet Union's political and economic system led to the collapse of the communist superpower. Gorbachev's career disintegrated in the process. He was 91. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
When the price of anything goes up, the consequences reach far beyond what you'd expect. But perhaps most of all, when it comes to food. In 2010, surging food prices helped spark the Arab Spring. Lives were lost, regimes fell, and the consequences are still with us. Once again, food prices are rising, and fast. Energy costs, broken supply chains, and surging demand were just some of the factors that have driven food prices to their first record high since the Arab Spring. And that's all before a war between two of the world's biggest food producers. Ukraine is called the breadbasket of Europe, and taken with Russia, the two account for about a quarter of global wheat trade. They produce more than half of the world's sunflower seeds and oil, nearly 20% of the barley. Now throw in rising energy prices, and processing, transporting, even refrigerating food gets more expensive. Plus, fertilizer production is extremely energy intensive. Less fertilizer means lower crop yield, and prices rise even more. The pandemic revealed how complicated and fragile global trade systems are. Global agriculture, perhaps even more so. Unlike metals, for example, food goes bad. And crops take months to grow and are vulnerable to unpredictabilities like the weather. Rising food prices will be felt everywhere, but the poorest countries in the world will be hit the hardest. And as all these factors compound, the real fear is that record high will lead to record high, and ultimately to a global food crisis with vast consequence.
Of cryptocurrencies today, you think it's now's the time to get in, it's good, or now's the time to wait to see where the market's going?
The biggest thing I would say is don't put in more than you're, fine losing.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg. Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Last month's jobs report caught everyone off guard.
This is quite a surprise. Oh my, as Dick Enberg would say.
That is a wow statistic.
That recession talk just got a freezing cold shower.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
It's good news, bad news, good news.
They're walking that fine line.
We still have a large gap between jobs and workers, but at least we're moving in the right direction.
The market has 2023 wrong.
The August jobs report, Friday on Bloomberg Television and Radio.
We're committed to getting inflation under control, and there's a path to get there. A recession is obviously a risk in the process. I'll just say, for context, nobody ever canceled the business cycle. So when you say there's a risk of recession, it doesn't have to be like a 2008 recession.
Thomas Barkin there, the Richmond Fed president, live from New York City this morning. Good morning with Tom Keene and Lisa Bramett. I'm Jonathan Ferro. Futures just about positive on the S&P after 3 days of losses on the S&P 500. Big losses as well, with positive just 2 points, up by not even 1/10%. It's pretty clear to me, to everyone, that Fed officials are saying we're happy with the market reaction, we're going to tighten, we're going to stay there, we're not going to back away. The first sign of success. The hurdle to pause, Lisa, is higher. The hurdle to cut is higher. Do you want to fight that?
No, and that was your question yesterday, and the answer that we heard from Sebastian Page was no. If you want to fight that and think that we're going to see gains, good luck, but you're probably going to get your face ripped off in Wall Street parlance. The question that I have is, what have we priced in? And some people are saying small caps, for example, have fully priced in recession. What about big tech? What about some of the drivers? What has priced in recession and what hasn't? And how much are people going to really discern between the two?
Short and shallow seems to be the theme. Tom, and not just on the United States, even in Europe. Just heard from Deutsche Bank there, talking about a European recession, and we still hear this short and shallow kind of story.
John, I have a huge problem with this because I've been wrong so many times. You can line them right up. Let's start with 1980 and 81 and the double recession wrapped around Paul Volcker. It's hard to pick the recession, let alone define it. John, it's even harder to get the magnitude right.
I couldn't agree more, Tom. And I'm not here to say it won't be a short and shallow one. It's not for me to say that. I will say I think we should be open-minded given how wrong we've been about so many different things over just 2 years.
John, we got to go back to it. We got a 348 in the 2-year. Quickly here, John, yen is just this far away from yen weakness. It's a global issue right now.
We've taken out the highs of the middle of June, June 14th, on a 2-year yield. We've taken them out. 348.27 right now came really close to 350. And back when we were at those kind of levels, Tom, in the middle of June, this equity market was a whole lot lower.
Folks, John Farrow has figured out that tuition in the United States is a breeze. This is the week where the tuition checks get written and the agony is out there. There's also agony in the political space. Jack Fitzpatrick joins us the end of August to reshape to September and the election. Jack, Pew does the best research on this. It is stunning when they looked recently at the political typology of America, how small the middle is. They've got 2 surveys, Republicans and Democrats, somewhere between 23 and 28% of America is the middle. Are they worth going after for these politicians?
In recent years, I think you can find some evidence that there's less focus on going after anybody who would describe themselves as persuadable. A lot of this is about motivation of the base. You see it in primaries. At the same time, you know, especially just looking at President Biden's speech last night, I think there is a bit of a persuasion attempt there when you hear him talking about funding for the police and funding and support for the FBI and kind of going on a two-track example. That, you know, there are some seemingly winning political messages that still go for a persuasion rather than motivation. But overall, big picture, the last decade or so has been a way more of a shift toward getting your base out, focusing on turnout, and that's a national trend.
Jack, sort of a personal question. I have the clearest memory of sitting on the couch, I believe it was a Sunday evening, when Lyndon Baines Johnson stunned the nation and said he would not run for a second term. Are we going to hear that tomorrow night?
That's still a big question in Washington. I don't know about tomorrow night. If that were the case, there's still the question about the strength of somebody like Kamala Harris and who would be the front runner for the Democratic position. I haven't heard from anybody who feels confident that tomorrow is the night, but you have heard some hints from Democrats who don't think that the president is going to run again. That came up in the New York race where Carolyn Maloney brought it up a couple times. It's something they're not supposed to say, but there is a bit of an expectation out there that the president wouldn't run again. I don't know if that's imminent or not at this point.
Just quickly, Jack, are we hearing anything about the student loan relief and whether that's actually going to get legally challenged, whether that's actually going to go into effect?
There could be legal challenges, but a lot of the pushback at this point has been Republicans talking about how the president should not have this power and what can be done in the future to take that away. It's a little hard to predict exactly how this would play out in courts if there is a legal challenge now. But again, a lot of the focus has been the political pushback and maybe some future legislative pushback, depending on how much Republicans take back in the midterms.
Jack, can I ask the question we ask every now and again? Where's Janet Yellen?
Still a little more low profile than you might expect for someone like her. Same story. A lot of focus on the Fed, some talk from the president on the economy. I wish I could come in here with an answer on the whole story about Biden and Yellen and the whole relationship. But a little bit quiet.
Jack, thank you. Down in Washington, Jack Fitzpatrick. TK, it is utterly bizarre. How do you manage to recruit one of the best labor market economists on the planet, the former Fed chair, to Treasury Secretary, and then tumbleweed, like
John,
kind of nothing?
I will never forget this. I was standing in the early morning looking across the White House lawn. This is Bush the Younger. and I realized that everything was run out of the White House. And there's been a modern disease. I don't know if it's the same in London, but there's a modern disease here that everything gets run out of the White House and the cabinet members are figureheads. Frankly, Mr. Blinken has been maybe a little less visible than Kissinger was, to say the least. John, we got a major issue on Twitter. Tots are tweeting out that it's a derby. Is it a derby or a derby today with West Ham?
Technically, that makes it a London derby. Though
It's a
typically,
derby.
we talk about a North London derby between Tottenham and Arsenal, and West Ham is an East London team, Tom, and Tottenham is a North
Well, I
London.
got to break up the surveillance nap for this afternoon, John, but West Ham, they've basically sucked since Nate Shelley joined the team, right?
I think you're well aware that he's not actually a manager, right?
Well, he's a coach. He's up from Championship League, I think.
No, I think Mr. Moyes will have a problem with that, Tom. You really do think that Ted Lasso is real life, don't you?
It is. Yeah, he came from Wichita. I think Wichita
When's the new
State.
season come?
I have no idea. I don't know. I mean, you know, it's a documentary, so they got to maybe have the history.
It's a proper documentary. They need to get the season wrapped up, and then we'll see how Nate did at West Ham. You're ridiculous.
Thank you.
Futures, positive 0.2% on the S&P.
We
on
should
the
go
Nasdaq
and do some
100,
research on this.
Up 0.6%. You're doing research right now.
No, in London.
You want to do a road trip to London?
Absolutely.
See how Nate's getting on
September
at
says
West
road
Ham.
trip London.
Bramo's like, count me out. Count me out. From New York City this morning, good morning. Heard on radio, seen on TV. For our audience worldwide, this is Bloomberg Surveillance.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
The markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets The Close, weekdays on Bloomberg. The top names at the Fed are on Bloomberg.
It is essential we get inflation down. People want jobs, but they also want low and stable inflation. We have to give them both.
Nobody covers the Fed like Bloomberg, your global business authority.
Live from New York City this morning. Good morning to you all. It's the price action, the shape of things so far. Early days. Up about 0.1% on the S&P 500. Call it 0.2 if you want. On the Nasdaq 100, up 5 or 0.6%, following the biggest three-day rout on the S&P 500 since June 14th, down 5% over the last 3 days. What happened back on June 14th? Yields topped out for the year, and then we took out the closing high of June 14th just yesterday in this bond market. 2s, 10s, and 30s look like that. We took out the June 14th high on the 2-year, not the 10-year. Right now, 348.27. New multi-year highs here. Yields higher again by 4 basis points. That's eating into the equity market over the last couple of days. As this Fed communicates pretty strongly. It's ready to go again. Go big if we have to, off the back of better than expected data yesterday, and then stay there. The New York Fed president to the Wall Street Journal yesterday found this very, very fascinating, that everyone's on the same page at the moment about staying there, and staying there, Tom, for a prolonged period of time.
The Fed speak, I'm baffled by. The Fed speak, frankly, John, we heard in Jackson Hole, and we get a new round of it today. Are we just going to hear the same thing? I think so.
Possibly. They're all saying on the same script, Tom. If you think the Fed is fascinating, confusing, pick whatever word you want, the ECB... I tell you what, the Hawks are in charge of the ECB right now, that's for sure. The Bundesbank yesterday were talking about going big again, even if you do fear a recession. Don't fear that. Let's go again. This morning, off the back of CPI coming in with a 9 handle, the Bundesbank communicating again, we need to act decisively. So picture this. You've gone on a German 2-year at the start of August from about 27 basis points at a close on the first trading day of this month to 1.2%. So that's a move of more than 90 basis points over the last month. And yet the euro is weaker on the month, not stronger.
John,
Euro dollar, Tom, 99.81.
You live this. Is Germany and France on the same page in terms of a let's go hawkish front-loaded tone?
At the moment they are, Tom. And the difference between potentially this ECB and what we saw in the previous 10 years under Draghi specifically is that this time the Hawks are in charge in a big, big way, Tom.
Yeah, they seem to be. There's no question about that. Let's jump to this right now. I'm watching yen again, which hasn't moved here, but still really front and center. Mohamed El-Arian just out moments ago with a 2-year chart that was very smart, showing the emotion of the moment. If your head is spinning here the end of August and you're worried about inflation gloom like Italy with 9% inflation, this is flat out the interview of the day and recapitulates what we heard from David Rosenberg yesterday. Luke Tilley's in a different place. He's head of asset allocation, chief economist at Wilmington Trust, and we're thrilled he could join us today. Luke, I thought your note was uncommonly cogent about the disinflation to come. Put a date on it. When does the disinflation show up?
Last month, we had a really encouraging reading in CPI and then also in PCE, clearly pulled down by energy. But what we're seeing is that weakening of inflation, much slower advances and outright declines in a lot of consumer goods, airfares, used cars, and a lot of those things that have pushed inflation up over the past year to year and a half. But it is kind of bimodal. We still have a lot of pressure on shelter and rents and on food. Those are running much higher than usual, but we do see a lot of disinflation for those other categories.
I like the idea of a bimodal. The theory here is any central bank, including the Fed, given a bimodal distribution, will always take the part of the bimodal that shows up later. They'll be massively ex post. Is this a Fed that reacts to a bimodal disinflation at the September meeting or at the September meeting of 2023?
Well, I think at the September meeting, they were likely to see a 50 basis point hike, and that's because we're going to get another inflation number, and I do expect it to be a little bit on the weaker side, not quite as weak as July, But what they're setting themselves up for is 50 basis points. And I think Jay Powell was talking a lot more about the profile when he was in Jackson Hole. That speech was clearly hawkish, but he wasn't really talking about the magnitude of hikes going forward. It seemed like, as you were just saying, they're all on the same page, and all of those FOMC voters are pushing back on the futures curve, which is showing rate cuts next year. So I think in September we get that 50 basis point cut. Another really important thing is what he said in July, not at Jackson Hole, is that the rate hikes that they've already done, we haven't felt the full impact of them yet. There's a lot of tightening in the pipeline, he said, and we're going to see those come through and slow inflation down over the course of this year.
So, Luke, when you say that you're already starting to see disinflation, and even with the hawkish tilt of the Federal Reserve, are you basically positioning around that and being more bullish on risk assets because the Fed won't go as far as the market is currently pricing? Or are you basically suggesting the Fed is going to, because they are so exposed, make a policy error and tighten into recession even if it's not necessary?
Well, we've never gotten so pessimistic that we went underweight. We're neutral across our asset allocation in the equity categories, and we have an overweight to cash. We're looking to deploy that because even though our baseline is for inflation to slow down, there's clearly a lot of upside risks. And the one that we're really watching, of course, is wages and labor. And Powell and the other FOMC members have talked about that. If those wages keep pushing higher, then they are more likely to keep tightening. And even if inflation was slowing, I think you get closer to a policy error and them causing a recession.
Well, just to make sure that I understand what you're saying, Luke, in other words, you're neutral on equities, you're neutral on risk, which is unusual for you because you are always invested, right? And you've been overweight cash, but now you're looking to deploy that cash. Does that mean you're getting more bullish, or does that mean that you have more conviction of the path of things going forward?
We're not expecting a recession, and we are getting a little bit more bullish, but that big risk out there is definitely labor, and we're likely to see data later this week, but looking for an opportunity to deploy that cash, a bias towards risk and a bias towards equities, and I would think that that would come in the U.S., especially as valuations have come down. But it remains to be seen how much labor market pressure remains.
So where are you seeing opportunity most clearly? In other words, are you looking at big tech? Are you looking at, for example, energy companies, even as we see one of the consecutive monthly declines in oil prices on the fear of a slowdown globally?
Well, if our baseline plays out, then we would expect to see, as Jonathan was just talking about, we haven't really seen long-term rates move back up very much. It's on the short end. We would expect the short end to come down a little bit, and that would point towards some growth stocks that would point towards a recovering economy and the sectors that really benefit from that, from long rates holding where they are and a little bit more growth.
Look, I trotted out yesterday one of the great series on the Bloomberg, which is simply CPI, not back to 1947, but our guesstimates back to World War I. And inflation, when it surges up, is wildly stochastic and comes down quickly. Given the pandemic and the supply side realities, the dynamics, I should say, are we going to see another bout of stochastic surge in inflation, reverse to disinflation?
I think there's a good chance that things come down pretty quickly. And this gets back to transitory, which I realize is a dirty word now. But we are looking at a lot of inflation that's been caused by that supply chain challenge from last year, and also a lot of stimulus, which of course is rolling off now.
Yeah.
So when you see Walmart cutting prices, when you see retailers saying, oops, we ordered too much stuff, that's where you could have it come down pretty quickly. Again, the risks are definitely labor, and I would also put energy in there.
I'm just asking for a friend, but if you get out front of this and the markets get out in advance, should I load the boat, let's say September 1st?
Well, I don't think that there's any reason to expect a recession other than the Fed keep hiking. So if the baseline inflation story plays out, and if you get some weaker wages, then I think we're in pretty good shape to have an expansion going from here.
Right.
And that would argue for risk assets.
What do your managers at Wilmington Trust think about cash? Is cash an asset, considering how conservative the shop is?
It's certainly more of an asset now than it was a few months ago, of course, but we're looking for stronger returns if that inflation story plays out. Then we do think equities are better. You guys were talking about credit spreads. There might be some spots in fixed income that are advantageous too, especially with high yield yielding what it is. But right now, from an asset allocation point of view, we're looking more on the equity side.
Look, when does the office start to fill up? What time? Just thinking, because Morgan Stanley, sent out the memo. They sent out the memo at Goldman, get back to work. When do they get in the office, Luke?
Well, there's for us, we've actually been back for several months. We've been back for 3 days a week for a long time now, just not quite this early. And there's a few people around me. You can't see them right now, but they'll be in pretty soon.
Luke Tilley, thank you.
John,
we appreciate it. Of Wilmington Trust. TK, go on.
I wandered out to a tennis match last night.
How did that work out, Tom?
I was sitting in the seats. I could watch Mets-Dodgers next door. I was sitting up so high. And John, there was no other topic in the chat I did with fans. Thank you so much for coming up, folks. Than work from home.
Tom,
that was the topic.
Can I just say that I turned on ESPN and the idea that you were sitting in the seats above, I saw you right there, courtside, sat behind Emma Raducanu.
Well, it was good
There's
seats.
no escaping this. They were great seats. Where did you find them?
The young lady from France was, the seats you mean?
Sure.
I don't know. Some of my people found them. I don't know that stuff.
Lisa and I couldn't get our people to find any.
They said, I got one seat. Do you want to go? And I said, I got to take vet bill. And they said, no, you can't. The dog's got to sit in your lap. And
Well, I'm getting poorer, Tom. You know why? Cable. 116.27.
Oh!
I cannot afford to go to the US Open. This move, Bramo, look at this. 116.26. I think the low of the session was about 116.18. You're going to go all the way back to 2020 and that big dislocation in the FX market. I'm sure you will remember that when we hit 114 or something like that in spring of 2020. Lisa, this is not a pretty picture for the UK.
Are you saying that it is because of the pound weakening that you did not go to the US Open? Is that what you're basically
Got
saying?
some sterling savings,
Okay.
and I'm looking at them now and I'm thinking maybe, maybe not.
I will say, just some of the projections coming about the inflationary backdrop in the United Kingdom is beyond shocking. It is beyond what we're seeing over in the mainland of Europe, and you do wonder how they're going to deal with it. What do you call it? Continental Europe? Okay. But this is, to me, one of the biggest stories, because how they deal with it is sort of a leadership role in terms of countering high gas prices with lower demand and inevitable recession.
This is going to make things much, much harder for the Bank of England, and I think for the ECB as well. We're seeing bigger and bigger expectations, Tom, of rate hikes from those two respective central banks, so the currencies aren't stronger. The weaker.
Yeah, well, that's true, John. But, Lisa seems stressed today, John, don't you think?
In what way, Tom?
I think it's the voice of a parent wondering if the children have the right calculator to go back to school. Lisa, are the kids properly calculated?
I don't know. They're asleep. And honestly, I'm going on vacation, so I'm not stressed at all.
They need the right
need to get to
calculator.
8:56:30
for 2 more days, and then I'm not off
8:55
ever again. So this is the last hurrah.
Are you coming back afterwards?
That's the plan.
I guarantee we'll see you
John,
Monday.
is she
And I'm never going to
always
be.
away?
Rather.
Yeah, exactly.
Okay, there we go.
What?
She's taking more vacation this summer than you and I combined.
It's fantastic. No regrets.
Futures up 0.2%. From a beautiful New York.
It's beautiful.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. More revelations in the probe of those classified documents found at Donald Trump's Florida home. In a court filing, the Justice Department suggests there may have been attempts to obstruct the investigation by moving some of the papers. The filing included a photo of files labeled top secret, said to have been found in the former president's office. The government was responding to his lawsuit to appoint a special master to review the documents. Europe faces the risk of blackouts, rationing, and a severe recession if Russia slashes gas deliveries further. And the next reality check is at hand. Starting today, there'll be a halt in gas sent through the Nord Stream pipeline. It's a key source of energy for the EU. There's a concern that Moscow will find another excuse to clamp down on those supplies. And prices in British shops rose this month at the highest rate since at least 2005. According to the British Retail Consortium, shop price inflation increased to 5.1% in August. The price of food rose even more, 9.3%. Shoppers are doing everything they can to save money at the checkout, including buying less food. Two of Wall Street's best-known investment banks say it's time to come back to the office. Goldman Sachs and Morgan Stanley are removing some of their last COVID restrictions. In New York, for instance, Goldman employees with an approved exemption to the city's vaccine mandate can enter offices with no testing or face coverings. The firm has been aggressive in pushing a return to offices. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
I'm paying attention to what the Fed is telling us. I think they're wrong. I think that Powell's already told us we are operating policy without focusing on what's happening on the supply side of the economy.
David Rosenberg there, the founder and president at Rosenberg Research, live from New York City this morning. Good morning. Tom Keene, Lisa Bramett and Jonathan Ferro. Futures positive just about up 0.2 on the S&P after 3 days of losses in the equity market, amounting to about a loss of 5%, down 5% in 3 days. Remarkable stuff. Yields up 3 basis points on a 10-year, 313.81 on a 2-year. We take out the highs of the year in the last 24 hours. Euro's weaker, sterling is too. Can we take a snapshot of sterling?
Yeah, John, 116.19. John, what's the emotion of 115? Is that like Dow 10,000?
I don't know if it's Dow 10,000, but it's certainly troublesome for this Bank of England as they're hiking interest rates and can't gain any traction whatsoever in the FX market.
What does that mean to the people of the United Kingdom?
They're not alone. Well, if you're importing inflation now, Tom, you import a whole lot more with a weaker pound sterling.
Unbelievable. What we're going to do right now, and this is a great honor to have Julie Norman with us. She's the co-director of the UCL Center on U.S. Politics, but is really definitive on continental Europe and, of course, terrorism and the study of the Middle East as well. Julie, we digress today to Mr. Gorbachev. Why does Mr. Putin hate him so much? Is it just as simple as he's the guy that gave up the Soviet Union?
Well, that's certainly a lot of it, Tom. And what we see playing out, obviously, with Russia and Ukraine today, you can just draw a direct through line back to Gorbachev and the dissolution of the USSR back in the day at the time when Putin was just kind of coming into his own in the KGB and just saw that dissolution as a complete tragedy. And I would say, too, it wasn't just the dissolution, but also the changes that Gorbachev made before that, the opening up of the media, the opening up of multi-party elections, the release of dissidents, all things that Putin, we know, has brought back.
I don't want to do a history lesson here, but the idea of Gorbachev and then Yeltsin, who's one of the things I've most been wrong on in my career, we come to Putin. Who's after Putin? If you look at transfer of power of Gorbachev to Yeltsin and the rest of the dance of the Russians, how can you choose who's after Putin? Do you have any idea?
I think it's a tough question, Tom, and partly just because Putin, as we know, has consolidated power so much around him and through the inner circle of the party that it's not like looking at, another country that we would say who's competitive in elections or who's popular or something like that. It's a very close circle, and it's one that we know Putin is going to hold on to as long as possible himself. So even the timeline on that is anyone's guess.
But Julie, Gorbachev's death really raises a question about whether Russia could be a democracy, whether democracy has failed as a project in Russia. Is Putin's legacy that whoever follows him will also be an autocratic leader because of the legacy of a democracy that did not take off in the way that many people hoped?
Well, it's a good question. And, Gorbachev himself, obviously from the West is hailed very much as a hero. But in Russia, at the time of his, at the time of his end of office up till now, was very unpopular because even in that early 90s period, he could not deliver on his promises internally to what people were hoping for. And that was the economic side as well as the more political side. So I think Gorbachev was hoping that those growing pains would be temporary. Obviously, things have gone another direction. I think in the long array of history, we know that doesn't mean a country is doomed to a certain trajectory forever, but it does probably indicate that it's going to be on that route for at least the coming years with someone like Putin and, again, the kinds of people he has put around him in charge.
Julie, heading into the fall, the focus very much will be on Europe and the natural gas situation, whether Russia's going to stop some of the exports to that region. Nord Stream 1 goes into maintenance for 3 days. Will it come out is the big question. What is the advantage for Russia to just cut off supplies? I mean, isn't it cannibalizing from all of its future revenues?
Well, it certainly seems that way, but it's also the main area where Russia, from the beginning of this crisis, has had real leverage and putting the squeeze on Europe, putting the squeeze on the UK, really just showing where they have this economic as well as political muscle. And so we see them leveraging that. And, I think a lot of this is also tied up with peripheral issues as well. So relations with China, relations with Iran, these are things that are kind of helping some of their allies, bringing some of them closer at the same time.
Julie, take us from the really, I think, pretty poor coverage in America of Ukraine away from the generalization that the Russian military effort is stodgy, slow motion, very doctrinaire, and the Ukrainians are making it up as they go, et cetera, et cetera. That's a stereotype. What's the nuance at Kherson or the nuance in the south, et cetera, the nuance on the Baltic Sea between those two forces?
Yeah, well, Tom, I think it's a good question because there's a lot that we don't know, and a lot of the coverage that we are seeing is, of course, telling the story that I think a lot of viewers in the West want to hear. And in reality, the war, as we know, is already quite long. We know that Putin is trying to, recruit more people into the army, so sees this as something that's going to be ongoing. In Kherson, for example, it's unclear exactly how much Ukrainians have been able to push back or not. There's a lot of controversy right now around the nuclear site, so the UN is going to be moving in there today to try and stabilize that. So there's a lot of areas, especially in the kind of the eastern part of the country where Russia has control that Ukraine is trying to chip away at, that is just going to be an ongoing slow slog moving into the fall and the winter. And it's attractive to want to see these victories, and of course some of them are there, but I think this is going to be a very long conflict, as many others have said as well.
Julie, thank you. As always, Julie Norman there of UCL Center on US Politics. Lisa, the consequences of this war will be felt for a long, long time, and these sanctions off the back of it. Look at what's happening in the UK right now. You do have to ask the question, how long would the resolve of this coalition last as the economic pain starts to materialise even more? Liz Truss, who is the leading candidate to be the next Prime Minister in the UK, is talking about plans to cut taxes and raise spending. Charlie Bean, the former Deputy Governor of the Bank of England, was on with our team in London earlier this morning and talked about the risk of a large sustained deficit in the medium term and how investors may start to think the UK doesn't look like such a good place to invest. What's been happening in the UK? Yields are much, much higher. Sterling is much, much weaker. What's the central bank's role in all of that?
It's a big question mark, right? This is unprecedented, and it's a very difficult place for them to be in. The question that you ask, though, about where is the resolve, how much is there, and how much pushback do you start to get as the economic pain deepens, that goes to the Jennifer Granholm point, the Energy Secretary in the United States, raising issues with the exports of natural gas from the United States to Europe because it raises the prices domestically in the United States. At what point does some of the alliances splinter in the face of economic pain that is very real and very difficult to combat from the central bank level?
It was the first question Tom asked yesterday when we went through that story. Tom, is the Department of Energy on the same page as the State Department and this White House?
No, in America, that's the way it is. But I think, John, to your point about currencies, and I think a lot of our listeners and viewers, John, say, well, why do we follow sterling? Who cares? It's the litmus paper of the system. John, I didn't know this. I just did the math here, which you can do quickly on the Bloomberg. Your sterling, John, February 24th, Putin. 14% depreciation.
Brutal.
That's stunning.
That's one
stunning.
One heck of a move, Tom. That's for sure. Futures are up about 1/3 of 1%. The Nasdaq bouncing back by 8 or 9/10 of 1%. We'll break all of this down with the brilliant Julian Emmanuel of Evercore. He's going to join us in about 4 minutes' time from New York City on TV and radio for our audience worldwide. This is Bloomberg Surveillance.
What are the moonshots at Amazon that are capturing most of your time and attention?
Well, we have a unique way that we look at big new investments, and I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? And if we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do. And any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine. In the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs. And the ultimate output for a company is share price. And then other big outputs are